Hey guys, we have Hal Press and Nikhil Shamapant. How are you guys doing?
Good. Happy to be here.
We're
Great.
post-early merged by about a day or two. We've been wanting to do a podcast to talk about the Thesis, especially heading into the merge. Yeah, this has been a long time in the making. For folks who may not know everyone here, Hal, could you give a short intro for yourself?
Yeah, sure. Hal Press founded North Rock Digital last year, at the end of the year, and have been quite actively following the ETH ecosystem specifically since then. I think, my philosophy as an investor is that I think 90% of your job is really to sit on your hands and sort of pass at the moderate to weak opportunities and do nothing, and then wait for the truly fat pitches. And then when they do come around, swing at them. So I think, one of the strategies of the fund, and probably the main strategy, is to take those sort of large concentrated bets where we really have conviction. And we identified pretty early on that the merge fit that bill. So we've been pretty singularly focused on this environment, this ecosystem, and this trade for the better part of the last year. So here we are.
Sweet. Nikhil.
Hey guys, so I'm Nikhil Shamapant. I'm a medical resident here in Colorado, and I did a lot of research basically since the last Bitcoin halving, and then published a big piece on Ethereum about a year later. So I've been thinking a lot about the merge. I think it's a great opportunity too, just like Hal, but I am a retail investor, and so I'm excited to just engage and kind of do my own homework on this and talk to you all and develop some thoughts.
Sweet. Okay. And I'm James. I am also, I guess, right now, an independent retail investor. Previously worked at ARK Invest, and after that, I was head of tokens at Moon, running a crypto project. I thought about, like, what is the common thread between the three of us? I think, other than being all very, very bullish on ETH and very into the tech as well, I think we've all put out one piece of influential literature each. Nikhil, you coined the term triple halvening. Really quantifying the Ethereum merge impact to classic Bitcoin happenings, and that's like a 69-page or something paper that was very influential last year. How you put out a piece, Ethereum is kind of like a generational investment opportunity. That really outlined your thinking around the merge. And the last year, when I was very much into the Ethereum ecosystem, still is, of course, I kind of encourage people to think of Ethereum as not just some coin that comes and goes, but as a software platform, almost like a AWS company with the Q1 Ethereum report, which Bankless has continued, which is great. So we're all very, very passionate with different perspectives on the ecosystem.
We have been talking about this podcast literally since that very moment. And as the merge has been delayed, because originally I think we had expected it to occur in April, so has the podcast been delayed. So this is like the fifth time we put the date down on the calendar. And finally, originally it was April, and then it was like, okay, maybe June, and then it was like, okay, maybe August, and then finally September, here we are. But it's actually happening now.
That joke that the merge is always 6 months away even took us as a joke. Like
exactly. Yeah, the merge has been 6 months away for 6 years.
When I first published, I think my report had the merge at November 2021. So
we were all right at the top. Yeah. You guys were at the November top. I was at the May top. We're just like worst indicators of all time.
So there's been a long time coming, and excited to finally be here.
Okay, let's talk merge thesis. I mean, the most recent event was the Gurley merge. We could maybe I think you have the most fully articulated thesis on why the merge as an investment opportunity, as a catalyst, is so powerful. You've already given the full length explanation on Bankless, and I think folks who want the full explanation should listen to that episode. But for a quick recap, how do you think about the merge as an event?
There was a tremendous amount of testing over the last, really multiple years, but especially over the last year and 6 months. And we went through, I think, close to 20 shadow forks now, which are basically, each one is its own dress rehearsal of the merge. And importantly, the code has basically been complete for quite a few months, and it's just been sort of working out a lot of the edge cases. And one of the things about Ethereum is that it's built on resilience. And one of the ways that they accomplish resilience is they have a lot of different client pairs. And so what that means is there's a lot of different software applications that actually run the Ethereum application on it. And that provides this resilience where if there's an issue with one client, it's okay because there's 3 others that can pick up the slack. But the complication with that is that each of the individual clients has to implement all the specs and work out each of their own edge cases. So you have 4 times as many edge cases. And so that's really what's been the holdup, is these client implementations. And we're finally to the point now where the shadow forks are running flawlessly. There really are no more client issues. And importantly, a couple of days ago, on Wednesday, we did do the final testnet merge successfully, Gorley, which then laid the foundation for actually setting a mainnet target. And the way that that works is the all core devs have decided on a date for Bellatrix, which is the pre-merge upgrade. And I believe that is set to occur on September 6th. And then on top of that, they have also set a target for what's called TTD, which is total terminal difficulty, which is essentially a target for mainnet merge. And what that means is, for a variety of technical reasons, they set a total terminal difficulty rather than a block height, which means at a certain amount of cumulative mining difficulty, the merge will occur. And you can kind of estimate when that will occur based off of the current hash rate, but it's impossible to say exactly because hash rate will vary between now and then. And so they've set it to target September 15th, 16th. But my personal guess, if I had to guess, would be that the hash rate drops a bit coming into the merge, and it probably occurs, on the 16th or the 17th. So that's where we are. It's extremely exciting because we finally have a target, and from now until then, it's really just coordination. It's getting client releases out, getting all the individual validators and operators to update their nodes, and then sit back and watch it merge.
That's the setup. From a investing perspective, what makes this particular event so, I guess, impactful that you literally created the fund to take advantage of that?
Sure. So I'm happy to talk about this, and then I'd really love to get Nikhil's perspective on this as well. I think for me, there's really 2 things. One I've spoken about a bit in the past, but I'll just sort of reiterate the bullet points on it. I look at crypto and any other asset class, just has a lot to do with my training. I spent 4 years at Morgan Stanley trading derivatives there. And after spending a long time in the market, you come to realize that what ultimately drives prices is flow. It's not actually fundamentals. Fundamentals may impact flow, but what ultimately drives prices is flow. And so I kind of view everything through a flow lens. And crypto is really interesting because it's actually an asset class that has structural sell flows. Basically, every single crypto asset, barring very, very, very small number, has structural sell flows. And what that means is every day, either miners are selling or VCs are selling. And so you need to find new money to come in and buy those pockets of supply just to maintain price. And it creates this constant pressure and constant headwind. And the fundamental reason for that is because as an industry at an index level, crypto is net income negative. So if you were to look at like total crypto projects and look at their revenue and their expenses are far larger. And so as a result, they need to constantly fund that gap. And the way that they do that is by selling tokens. And so that is where the actual supply comes from. If you look at the S&P and you look at their revenues and expenses, the revenues far outweigh the expenses. And that is why the S&P structurally and fundamentally has structural inflows, and those come in the form of buybacks. So that is like a very key fundamental difference for me between the 2 industries. And that kind of leads to why I think this event is so profound, because this event is the single moment that crypto will effectively christen its first large-scale structural demand asset ever. So when we merge, Ethereum will go from, when you do that same revenue over expenses equation, the expenses being larger to the revenue being larger. And the reason is because the merge will essentially cut expenses to 0. And not just that, but also Ethereum happens to exist in an environment where they already do generate real revenue, unlike almost all other crypto projects. There are a few others that do, but Ethereum generates the most. And that combination of having significant revenue and then at one moment in time, reducing the expenses to zero is very, very powerful from a flows perspective, from a narrative perspective, and from a fundamentals perspective. So that is, and quite frankly, that setup, you never know for certain, I think is unlikely to ever repeat in the history of crypto. I don't think you will ever see this again. And so that's what makes it so unique to me. And then on top of that, I think the second thing from an investing standpoint is because of that, and because of kind of where we are in the market, I think it's a very digestible narrative for a lot of different pockets of money, for family offices, for institutions, and for retail. And so I think you have this opportunity now to kind of re-engage those parties in the market around this thesis. And the combination of those two things are what makes it so compelling to me.
Great.
And I would add the sole example that kind of you could look to as a litmus test for how this will look after merge, and I've talked about this a bit on Twitter, is BNB. And they are the one other L1 that does have structural demand. The reason they have structural demand is because they're quite centralized and therefore they don't have any issuance because they do all their validation internally. And they do also have some revenue. I think there's a couple differences why I think this is even more profound than that. But if you look at that and you look at like the BNB BTC chart, it's essentially up only and it's made all-time highs in the middle of a bear market. So it does illustrate the example. And then I think this is even more profound for a couple reasons. One, like I said, BNB is quite a centralized chain. And so it doesn't really necessarily tap into all the same pockets that Ethereum does. And number two, BNB never had this transition. It was never like BNB was proof of work and had structural supply, and then at one moment in time switched to structural demand. They've just always had structural demand. And what makes it so profound for Ethereum is not just that it's going to be structural demand, or that it is, it's that it is transitioning from 6 years of history of structural supply, where we have literally absorbed miner self-flow of billions and billions of dollars per year for years. And we've built up this base of buyers that absorbs those miners every single day and sort of built up this positioning and this behavior over time. And then at one moment, we just magically remove the person that's been selling to them for those 6 years. That is, to me, the difference.
You know, a lot of folks are much more familiar with equity investing. And the key thing that's happening here is that by changing the core consensus algorithm to proof of stake, the cost of operating the network is coming down by roughly 90%. Is that right? Like the
That's right.
To mine. It would be like if you had any traditional business and you previously had COGS of I don't know, you previously barely broke even,
yeah, exactly right.
Yeah, right. If you barely broke even, you have 0% roughly gross margins, and then all of a sudden, after one very specific event, let's say you upgrade from like horses to software, internet, or I don't know, to cars or something, to rail, your cost of transport or your COGS went down 90%. So you went from a infinite PE company to like, I don't know, well, infinite you can't go, but you all of a sudden now you basically have like price to earnings because you actually have a positive 90% gross margin. It's a profound step function change in the whole income statement from a software upgrade.
And just one point to add on that, just really quickly. Nikhil, you go first. I'll add after.
Well, actually no, you go first because I was just going to kind of take it in a different direction.
Okay, just really quickly on that. While the issuance goes down 90%, I would argue that the expenses actually come down 100%, because the issuance does not go to miners as it does under proof of work. It goes to stakers. And so I actually don't view that as an expense because it actually accrues back to the holders. So it's really 100% reduction in expenses in my opinion. But that's just a small detail.
It's an expense for it's like a tax on people who don't provide security to the network.
Yes, if you're a staker, it's actually not just an expense, it's a revenue. But if you're a non-staker, it's still an expense. But like if you look at it as network level, it's fine.
Exactly.
To be
one, it gives you incentives to I'll go for it.
Yeah, to be precise, this is like you count expenses only from a flows perspective. You're still giving away these units, right? You're giving them away to the stakers, but you're saying they won't sell. So from a sell pressure perspective, it is 100%. Is what
not quite. Okay, so if you have an equity and they pay a stock-based dividend, is that an expense?
In
No,
cash,
the share split is not.
Yeah.
It's not cash. It's stock-based dividend. What?
Oh,
Cash or stock-based. Well,
Like
either
if-
one.
if
Either way.
Apple does a
Either way,
2-for-1
dividends
split-
are not expenses. They're not expenses. They're just what you do with your cash. Staking rewards are a dividend.
Okay.
So that's
I guess to me
that's
the
where-
mental
yeah,
model.
The
is
reason,
almost-
so yeah, the
Yeah, go
reason
ahead.
is because you can't just like, it's not like you're distributing this cash to anybody. You're only distributing it to holders. It's not like you can just come and claim this cash if you're just some like Joe Schmo on the street. It's only because you're a holder that you can get it. So in that sense, it's a dividend. It's not an expense. You're not paying like some outside service for their work. You're paying a holder for being a holder, which is a
Why is
dividend.
that distinction important? Like, what is outside? What is inside?
So
Ultimately, it's a
so let's-
third
let's-
party.
let's Imagine
It's not a
that
third
everyone,
party, it's a
this is-
holder.
This isn't possible, but imagine that everyone, all the Ethereum was staked, and then you paid out like 1 Ether to every staked Ether holder, right? Ultimately, the value of ETH would just get cut in half because you just have 2 times as much ETH. Nothing else would have changed, and everyone would just nothing. Like the value of our ETH holdings would all just stay the same, right? So that's his point. Is like ultimately, now there is that complication of like not all the ETH is staked, not everyone who holds ETH.
But
is
just
a
to go to
staker,
the first
but
point
for
before
the
we get there,
stakers-
the fact that nobody lost money proves it's not an expense.
Exactly.
Because if it's an expense, then it's leaving. Like, okay, if you have a lemonade stand and they pay for a table and it costs half the market cap of the lemonade stand, the market cap gets cut in half if that table is worthless. So that fact that you can distribute the staking rewards and have no impact on market cap is actually proof that it's not an expense.
But
Yeah,
on
the
a per
analogy
unit.
is a share split.
Okay. From a stake.
It's an interesting
But
and
if you're, this
counterintuitive
only is
concept.
true if you're staked, right? If you haven't staked, then you're being diluted.
Yes. So there's a separate point. I'm talking about when you look at an index level, but a system level. But there's a separate point, which is that the staking is effectively a transfer of value from non-stakers to stakers. And the stakers are effectively eating the free lunch of the non-stakers for free. So yes.
Yeah, it's a structural incentive to stake and disincentive to not stake. Because
that is
every
ultimately
moment
what's
you
going
sit
on.
there not
Is
stake,
that
you're paying for it.
So if
Free
you think
lunch
like, okay,
sounds
you're a token holder.
Too aggressive, right? Free lunch is almost saying like I don't know, if I don't, it's almost like there's an opportunity cost to staking. If you unstake, you can use the thing. You can use ETH as the utility token. So it's
Free
like
lunch
a
is the
trading
wrong word.
opportunity cost, right?
Free lunch is the wrong word. If you stake, you are making the decision that you are willing to lock up your ETH in exchange for taking the profits of all the others that don't lock up their ETH. That's basically what's happening. And if you don't lock up your ETH, you're saying I'm willing to forfeit all my profits to those that are willing to, because I want to use my ETH.
Well, so yeah, I think free lunch is not the right word, but I do think, I mean, I've talked about this before, like, I think that there is, especially after the merge, there's a staking arbitrage trade, and arbitrages aren't risk-free, but they are like supposed to be risk neutral. Like the risk is isolated to that specific trade. Like in this case, it's isolated to the risk that something happens to staked Ether that doesn't happen to unstaked Ether, right? And if you're willing to take the risk of being a staked Ether instead of an unstaked Ether, you get paid that staking yield for doing that. So I don't know, we can talk about that a little bit more.
And then last, I would just say on this, and then Nikhil, then you can go to your long intro. It is actually quite an interesting point though, because what this, and I was not planning to get into this so early in the podcast, but here we are. What that staking versus non-staking dynamic does is it enables those that are willing to stake to effectively buy into the asset at a significantly cheaper valuation. So because you, like, let's say right now, there's only approximately 10% of people on ETH that stake. So that 10% will effectively generate the revenue of the entire network and take the other 90% share of it. So their revenue share will be magnified 10x. So you can have a network that only generates like 10% or let's say 2% of its value in profits every year. But for a staker, they'll get that 2% times 10, and they'll actually earn 20% reward on it. So that dynamic creates a very, very favorable opportunity for those that are willing to stake to effectively buy into these assets at significantly cheaper valuations.
It's almost like if you were Nikhil, it's actually, you know what, also I want to hear, Nikhil, you wrote that very long piece. It's been a year or so since you know, that when you put that out. I'd love to know how you think about like what you've learned and what things have you changed your mind on, and what do you still believe in?
Yeah, I mean, so it's a pretty similar thesis. It's why we had a lot to talk about, I think, because then when we figured out the differences, we get into lots of interesting corners. But I think one thing, so I was thinking about the analogy that you guys were both using around costs and expenses, and the idea that the merge reduces the costs. And one thing I really like about that analogy is that it covers not just miners selling, but it also covers VC liquidations. And so that starts to get really important when you look at non-ETH or Bitcoin assets too, where because you look at like something like Solana, something like Chainlink, I think especially, where you know, the team selling starts to really weigh on price almost more than like kind of mining related selling. And if you want to take this model for the merge and apply it to these other crypto assets, you have to kind of include those other things. But one thing that I think starts to kind of get difficult for people to map is that obviously, like we were talking about, the analogy works really well if a company was returning capital to their shareholders in stock. But for a lot of companies, like if you own Apple stock, their revenue isn't directly being used. I mean, some of it's being used to repurchase, but all of the revenue and all of their expenses are not going to repurchase or dilute shares on a daily basis. I think that's where crypto assets are very unique. And when you look at something like Bitcoin, like we're not just saying, oh, like there's all these VCs who are going to dump Bitcoin, although there are kind of unique dynamics there about Mt. Gox and all sorts of interesting things. But we're actually just saying like Bitcoin is, and Ethereum and anything with miners, structurally different because the expenses are literally paid out to someone who has to sell in order to fund their operations. So we're saying that like the miners' electricity costs are directly expressed as sell orders, where Apple's like hardware expenses are not directly expressed as sell orders on Apple stock. And that makes the market for Bitcoin and Ethereum unique. And it means paying attention to the costs that those miners have and how they change before and after the merge dramatically affects the price of these assets. And actually, I think people get confused on that. And like, how does this translate from the expenses of a business to the expenses of an asset that is sort of autonomous? But that's, I think, where I see the connection. And so then I completely agree with Hal, where I think then I look at the, when I see the price of an asset changing, I see it as the effect of flows. So if the price goes up, it means that there are more buyers than sellers at the previous price. So the price had to go up until kind of supply emerged to fulfill those buy orders. And so you can actually start to like look at, okay, well, if that's your model for how market prices work, then how do miners work? And I think when you're saying miners are structurally a supply pressure, like that literally means where the price is right now, there are enough buyers to buy up all of that extra Bitcoin, all that extra Ethereum. And so if all those sell orders are removed from the market, then the price has to go up until new sell orders come from existing holders. And that's kind of the original thesis of where this whole effect was going to come from. So I think apart from that, I think maybe one difference is that I focused a lot in my thesis on kind of post-merge staking effects. And so my thought was you get EIP 1559, and after the merge, not only do you have a reduced cost, but and how highlighted this, you get structural demand where you get, you know, the ultrasound money, ETH is deflationary thesis. And rather than a macro thesis about the effect of a deflationary asset, my thesis was always just, well, like now you have structural buyers, like how I was saying, now you don't have structural mining sellers, you have structural buyers where people need to buy in order to transact on the network. And the opposite kind of happens where, okay, well, who are they going to buy from? They need to move the price up in order to buy from someone who's willing to sell to them. And so this gets progressively harder when there's less and less Ethereum on the market, whether it's because we're burning it, whether it's because it's being staked away. I mean, we kind of talk about the attractiveness of staking. And it kind of more directly connects the revenue of the network, which is these fees, to the price, where before the revenue was dramatically outweighed by the fees, where the miners were selling more than the fees that were being collected. Now you actually get, not only do you get the reduction in costs, but you have these multiple ways that the revenue gets connected to the actual. It's like if Apple started not only reducing their costs, but taking all the revenue and using 100% of it to buy back shares. And it's like, well, Apple stock would start moving differently after that happened. And I think we're looking at an environment where a lot of crypto traders are looking at charts and drawing lines on them and saying, like, the price is going to go up because of this line I drew. And we're saying, well, you're going to be, I think, surprised when suddenly the market starts moving differently after this event, because those prices like represent something.
And just to synthesize that into a very distinct number, right now, the current dynamic is that you need about $16 million every single day to buy Ethereum for the price to not go down. Post-merge, you will not only not need any money to come in, but you will need about approximately $3 million of sellers every single day to keep price from going up. And so that is the shift that's going to occur.
And that 16 million today exists because the Ethereum blockchain is generating new ETH per block. And this is given to the miners, and the miners have to sell it because they have to pay for their expenses. It's structural.
There's about 15,000 ETH issued a day. And I assume about 80% of it is sold daily on average. Obviously, on any given day, that number is going to be different. Some days it's 0, and some days it's 300%. But on average, it's about 80%. I've spoken to a few mining organizations and kind of tried to triangulate that number, and I think that's a reasonable assumption. And so there's 18 million of gross issuance, and there's 15 million of sell pressure.
Okay, cool. All right.
Or actually, no, that was incorrect. There's 28 million of gross issuance, 18 million of sell pressure, and 3 million of buy pressure, which creates a net 15 million.
Okay, so how you're writing and publishing kind of part 2, an update to your original thesis. Things have changed a lot since then. The activity on the Ethereum, ETH obviously has dropped a lot in price. Activity across Ethereum has dropped a lot as well. Some of the core metrics have changed, but you've done kind of the updated math. Could you walk us through, like, what are the key changes and what does that affect? How does that affect the ultimate model?
Sure. So yes, I have been working on a piece, and I actually just finished it yesterday at 3 in. It's been a long month. So I will be publishing that at some point next week. But I am quite fresh on the numbers because I just literally refreshed them. And so where we stand is, yes, fees have come down a lot. Fees have come down in notional value, but that's largely a product of the fact that ETH price has come down. But on top of that, fees have come down in ETH value as well. As activity has slowed and ETH price has declined. Both things have occurred. So we're now burning, or there's now about 2,000, or between 1 and 2,000. Recently, fees have started to rebound again. There's been a little bit of some green shoots, as I'd call them, have started to form. But we're in this zone of, call it 1 to 2,000 of ETH being used for fees per day, and that's kind of like our demand side. And then the supply side never changes. It's just the 15,000 tokens a day. So yeah, the way the math works out is as I articulated earlier. There's about 28 million of gross supply. Now 18 of that gets sold, and then there's about 4 million of demand for tokens each day, and that gets bought. So between the two, you've got this 18 less 4 is about 14 or 15 of net outflows per day. And then the one thing I'd say just about the activity that I think is somewhat interesting, and I talk about in my paper, is there's, I think, 2 reasons why the activity has decreased to the level that it has. And this actually raises another really interesting conversation, which we can get into if we want or not. But
I Activity,
lot of
you mean like
applications.
active users and things like that.
So the way that I normally thought of activity was like, okay, let's just see what the fees spent were. That's a good litmus test for activity, because the way that the fee market works is it's an auction. There's like the block space is always fully demanded. So it's just what the incremental buyer and seller is willing to spend, and that's correlated with the amount of activity. And so total fees spent is usually a good proxy for activity or demand for block space. Now, the twist, which I didn't realize until only a couple months ago, is that activity is not the only variable that flows in there. There's also an efficiency variable. So the place where the easiest example of this is OpenSea. So OpenSea is one of the largest consumers of gas, and they had an upgrade a couple months ago where they basically made all their contracts like 35% more efficient. So the exact same transaction now used 35% less gas. And I've also seen them do a lot of things where like you used to have to actually do an on-chain transaction, and now you only do a signature. And so that's just like removes a transaction completely. So all these sort of applications have become much more efficient, where even if you have the same amount of activity, the gas consumption is far reduced. So I think the reduction that we see in gas expenditure is not one-to-one correlated with a reduction in activity. I think the reduction in activity has actually been quite less and started to pick up recently. And one of the like really easy places to see that is if you just look at the active users, the active Ethereum addresses, which has actually rebounded quite significantly over the last month, despite the fact that gas has had only a more modest rebound, and is actually closer to levels seen during the bull market. So like in that context, I think activity has actually rebounded to a fairly healthy level. It's just that gas is on a different kind of, like a totally different base now, with all these applications having become more efficient. And so from there, that's just one kind of important nuance. And then I think a very logical and interesting discussion from there is kind of, what is the optimal fee pool? Because it's not as if you just want as many fees as possible, because at a certain level, you price people out of the ecosystem and adoption dries up. And I think we really actually saw that in the last kind of bull run, when you had like $300 Uniswap transactions. People were like, F this, like I'm not paying $300 to swap a $20 trade. Like I'm going to go to Solana or Avalanche or whatever. And I think, kind of long term, these issues will become less relevant as more and more activity moves to L2. But today they're still relevant. And so like, what is the actual optimal fee pool? And actually, to me, I thought about it. It's interesting. It's like, what do you value more? Do you value adoption more, or do you value daily buy pressure? Because actually adoption does also lead to daily buy pressure. So it's not really like an easy answer. Personally, I think the optimal fee revenue is the fees at which you generate enough fees to burn all issuance and basically make your security budget covered, and you not actually have any expenses from issuance. And on top, but it's kind of like in conjunction with that, you have enough fees to burn all issuance, but not more than that, because more than that, you start to increase fees to the point where you push users and adoption to other chains. That's kind of the place where I settled at. That kind of made sense to me. And it is interesting. That's pretty much exactly where fees have found an equilibrium. And as they found an equilibrium there, we have also seen users start coming back to the ecosystem as things have gotten cheaper. And I think people have started to come back for other reasons as well. So it's early, but it seems like that's playing out a little bit, and it's kind of just an interesting thought experiment.
Well, I think fees should probably find an equilibrium there long term. I mean, they can be dislocated for a while, but in between. Right. But long term, if fees are so high persistently, this is going to be more the case post merge, when the relationship between fees and price gets a little tighter. But post merge, if fees are persistently much higher, and we have like a large amount of deflation, what we should see is that price should rise until eventually that's no longer the case. Because when the price rises, like the amount of yield is gonna, or the like dollar amount of the yield is gonna increase to kind of cover those fees. And so we should kind of, and similarly, if the fees are incredibly low, there's like not gonna be enough buy pressure. In theory, it should have like equilibrium effects on a downward basis too, where you have price dropping and eventually yield dropping until kind of they balance out again.
James, I think you wanted to say something. I have a response to that, but I think you want to say something.
Yeah, I guess, why do you think just at this equilibrium is optimal? Why, for example, would it, for example, if fees were, if the network were slightly dilutive, but you had lower fees and you can incentivize people to onboard more, almost like a marketing expense, why isn't that potentially better?
Okay, so first of all, to Nikhil, I agree with you to a degree. The quirk and the kind of nuance, though, is that as fees are ETH denominated, they're not necessarily price elastic. So, meaning, just because the price comes down, it does not necessarily incentivize more fees, because a lot of people denominate in ETH. And just because prices go up, it does not necessarily incentivize less fees, because people denominate in ETH. And I think we've actually seen that, right? Like generally, fees, even in ETH denom, are highest when prices are high and lowest when prices are low. So it's like, yes, in theory, like that might make sense, but in practice doesn't really play out. So I think there's really like kind of other forces that dictate that before those forces really come into play. To answer your question, James, why do I think that's the optimal place? There's no scientific answer. Like, it's a little bit finger in the air. I think the reason that I come to that place, though, is because I do think you want to be able to be in a place where you're roughly keeping supply constant. Like, I think there is a benefit to that, to not being very dilutive. Like, maybe if you have like a tiny bit of dilution, that's fine, but you want to be roughly supply constant. Just that helps for a lot of reasons, but like the biggest is just a mental reason, right? Like, people want to own an asset that they feel is scarce, especially if you're going to talk about it as a store of value, which we can get into later. I think that's somewhat important, and also for the flows. And then the reason that you don't go more the other way is because the reason you said, which is like, you don't want to disincentivize adoption. So for me, it's like, there's kind of a function, right? And when you are dilutive and fees are too low, it is more advantageous to increase fees to become not dilutive than it is punitive to hurt adoption. But once you pass the point where issuance is flat, then that equation flips, which makes a local optimization right at that point.
Okay, cool. Let's see. What do you guys want to hit on next? I think we were going to talk about.
Well, I guess one thing I didn't talk about, which is on there, and I missed this. An update on the numbers that's also relevant, and also raises another interesting point, is where is the staking rate going to be? So when I published the last piece, I think fees were much higher, and I think the staking rate I estimated was somewhere around 10 or 11%, which is no longer realistic today. So that's also worth updating. So with current fees, we're looking at about a 5.2% staking rate. Now, 4.2 of that is going to come from issuance that will also be burned.
Not here. You don't mean the percentage of people staking. You mean the yield of the stakers, right?
I mean the staking APY.
Yeah. Okay.
Yeah. So what we're looking at right now, if we merge today and we use the last 7 days as history, you're looking at approximately 5.2% staking APY and exactly even issuance. So not deflationary or inflationary. You burn all the ETH that you issue to stakers, and stakers get an extra 1% from fees, but there's no deflation, but there's no inflation. And that's kind of where we are today, which is 5.2% staking yield post-merge. And so this is another interesting point, which is that doesn't sound like a big increase. Like, okay, I stake my ETH today, I get 4.2%. Post-merge, I'm going to get 5.2%. That's like what all the hoopla is about. That seems a little bit anticlimactic. However, there's a lot more going on than just 4.2 to 5.2. To understand why, it's really important to break down what is a nominal yield and what is a real yield. So a nominal yield is the number on the sticker. If you go stake at, I don't want to pick on Solana, on Avalanche, or whatever. Okay,
Pick on stuff. It
Cosmos.
doesn't matter.
Cosmos.
They're big boys.
If you go stake at Cosmos and you stake your atom, and I think like the staking rate's like 15% or something. It's like, okay, great. I'm staking my atom, I'm getting paid 15%. That's the nominal yield. The problem is everybody stakes. So the network inflates by 15% a year. So what is your real yield? You get paid 15%, but your portion of total tokens goes down 15% otherwise. So that 15% only keeps making you whole. You don't actually earn anything. You earn zero. And so your real yield is zero. Despite the fact that you get paid 15%, you're also losing 15% to inflation. So to get to a real yield, you have to look at your return minus the inflation or deflation of the network. So if you're receiving 15, but your network is inflating 15, you're just breaking even. And so that is a situation that occurs right now with Cosmos. For ETH, it's actually quite similar. So right now, you are receiving 4.2%, but the network is inflating at current run rate 4.1%. So you're actually generating a real yield of 10 bips. Right now, if you stake Ethereum today, your real yield is 10 bips. You're effectively buying the network at, I think it's 1,000 times earnings. I'm pretty sure that's what the math works out to. Now, post-merge, your real yield. So, okay, what are you going to return? You're going to return the 5.2%. But then what's the inflation deflation of the network? It's no longer 4.1%, it's zero. So that is where the impact is really felt. It doesn't show up in the nominal yield, but it does show up in the real yield. So instead of 4.2 minus 4.1, it's 5.2 minus zero. So your real yield goes from 10 bips to 520 bips. And that creates the highest real yield in all of crypto.
Your
Well,
0%,
and I wanna-
your 0% is assuming the stakers 100% do not sell, right? That's how you get the zero.
No, that's not how I get to zero. How I get to zero is the ETH issued to stakers is exactly equal to the ETH burned from
Oh, I
EIP
see.
1559.
Okay.
Yeah. Well, one thing that's cool that you've mentioned to me before is that this concept of real yield. So as soon as you have that concept, and not just in theory, this is like you said, the atom stakers are actually getting this money, but if they're really smart about it, it's being diluted away. But the Ethereum stakers are actually getting this money, and it's not being diluted away. So what they now have is an asset that earns a cash flow they paid a certain price for. And so now you get 5% yield is a 20 times earnings multiple, right? And it's like an after-tax earnings multiple. So when you then go, okay, like how do I compare this to other assets? You go, well, I mean, because we've just been talking about fees. We think fees are cyclical. The more price goes up, the higher that fees could go. We think that more that the network grows, the higher fees could go. And similarly, when you pay 20 times earnings, you can kind of project where you think the yield could go in the future and value it that way. And 20 times earnings for an asset like Ethereum, which represents so much of the growth of the crypto space, I think it's going to sound like a deal to a lot of people.
And just to like give people a bit of a visual on this. So here, can you guys see my screen?
Yes.
This is how the numbers break down. And I'll publish this in my piece, which I'll put out later next week so everyone can have it. But this is how the numbers all break down. So this is the 5.2 that you're going to get post-merge. This is the current real yield that you're getting. It's effectively zero. This is the real yield that you'll get post-merge. These are all the buy and sell pressures, et cetera. And so the last thing that I'd say on the real yield is that, well, first of all, it's real. And so that is extremely important. And then there's two things I'd say. So one thing that I think is underappreciated is that there's like, it's not just some number, like, okay, you get this real yield. What does that mean? It actually is an extremely important fundamental value driver. And the key part here is over time. So right now in crypto, if you own any crypto asset pretty much, you're fighting a time headwind. So as time passes, you are draining money to the ecosystem, all else equal. Now, if more people come in and speculate and buy the token, then you might make enough to offset that. But time alone is a headwind for you because your real yield is negative. Basically, real yield is what determines whether or not time is a headwind or a tailwind, and how much of a headwind or a tailwind it is. And because ETH will be basically the highest real yield and one of the only real yields in the space, it's really the only asset for which time is going to become a tailwind. So post-merge, that's a really important concept to me. If you own ETH, every day you're going to start with an advantage because you're going to be generating.
You have an example here with the lemonade stand. Why don't you walk through us? and when lemon token?
Sure. I guess we can go through that.
It's a very useful.
All right. I'll go through it. But the last point I'd say is, okay, fine. I'll do it at the end of the lemon example. Okay, so let's imagine you have a lemonade stand, and that lemonade stand generates $1 of earnings per year. And we're in a market environment where but that earnings never grows. And I guess I'd just preface this with the point that I think most people misunderstand this concept, which is kind of interesting in its own right. I think most people think like, okay, if you look at the S&P, why does the S&P go up every year on average? Most people would say it's because earnings grow and the multiple inflates. I think that's the answer most people would give you, but that's actually not the right answer. The right answer is because time passes. And to understand why that's the right answer is because this example. So
time passes and the reality of those companies stay at least as good, if not better.
Right. On the average, as long as, I guess the point I'm trying to make is, as long as earnings don't decline and the multiple doesn't decline, even holding those constant, so long as time passes and companies remain profitable, the S&P will rise over time. And that's like the main engine that fuels that price appreciation. I wouldn't say it's the main engine, but it's one of the core engines. And so to illustrate that example, let's say you take a lemonade stand and has $1 of earnings, and we're in a market environment, but that earnings never grows. And we're in a market environment where the market is willing to pay 10 times that earnings. So if someone says to you, I'll pay you $1 every year for the rest of your life, what will you pay me for it now? For that annuity, you'll pay them $10. That's the market environment we're in. With that, and that kind of thing is dictated by interest rates and other things. But let's just take as a given, that's where we are. And then this lemonade stand also has $0 of debt and $0 of cash on its balance sheet. So all it has is this right to make $1 of earnings every year into the future. It's got 10 shares outstanding. What's each share worth? So the logical answer is that the company's worth 10, it's got 10 shares, each share is worth $1. The reason it's worth 10 is because it generates $1 of earnings and the market's willing to pay you 10 times that earnings. Okay, so it's worth 10 and your share is worth 1. What about next year? Nothing's changed. The company still earns $1 a year. Market still pays you $10 for that earnings. So most people would say or I don't know about most people, but some people would say it's obviously still worth 10 then because you still have the earnings and that's it. But that's actually not correct because a year has passed and what's happened is that the lemonade stand has generated $1 and that $1 now sits on their balance sheet. It doesn't disappear and the market values that $1 because that $1 is essentially owned and accrued to the equity holders. And so the company is no longer worth $10. It's worth $1 for the $1 on the balance sheet plus the $10 that the market is willing to pay for the future earnings. So it's now worth $11. And so each share, the share count hasn't changed, is worth $1.1 or $1.10. So each share has appreciated by 10%, yet no earnings have grown and no multiple has appreciated. All that has happened is that time has passed. And so long as you have a company that is profitable and time continues to pass and the other variables don't decline, your investment will accrue in value. And that's what I mean when I talk about this time tailwind. And so equities have this, and this is what makes equities such a good long-term investment, is that they receive this, what I would call time harvesting dynamic. You actually harvest time so long as you own profitable equities. Crypto, on the other hand, has a reverse time harvesting dynamic because they pay money every year. So the longer that you hold it, so long as everything else is held constant, the more money you will lose until the merge. So post-merge, Ethereum becomes first large scale, BNB being the other smaller scale asset that actually generates from, or actually benefits from this time harvesting dynamic. And you will then have time as a tailwind instead of a headwind. And the other thing about that I think is really important is that like that concept itself is, I think, very important to institutions on multiple levels. Like A, they want to feel like they're in a sound long-term investment, but B, like they actually want to realize that they are generating a real yield that is coming from something. It's not fugazi and like just like people playing games with tokens. It's like, okay, people are willing to spend money to use this network, and the dollars they spend accrue to you, and the cumulative sum of those dollars is greater than the expenses of the system. So you are profitable. And that concept is really just distilled into this real yield. And that concept, I think, is very powerful, especially for institutions.
Let's just pause on that and just focus on that point for a little bit. What you're basically saying is, up until roughly speaking this point, all of crypto has been just a highly dilutive set of games that you play, and you can make money if you happen to time it correctly of when extra cash inflows from speculation comes in and juices and pumps your token by 2x, 10x. That's how you make money. But over the long arc of time, it's basically decaying because it's issuing way more value than actually organic value is occurring to the network. You're saying basically post-merge ETH will be the first blockchain or protocol that generates real yield in excess of the amount that it's diluting people.
Other than BNB.
Then the question, yeah, other than BNB, like less so, but the second best, right? And in terms of this this equation. Now, after Luna, especially, people are like, there's an adage is if you don't know what the yield is, you're the yield. So let's like just be a little bit explicit here. Clearly, the only way this equation works is people are willing to pay money to use the Ethereum network to do something. What are people doing right now to generate sufficient dollar value of activity to make this a positive PE company at 20?
Sure. So I'm happy to answer that question, or Nikhil, you can answer that question, or James, you can answer that question. I feel like we all kind of are equipped to answer that question.
My understanding is the majority, that the number one use case is NFTs, right?
So, okay, so
well, it's transacting.
You go ahead, Nikhil.
So yeah, I was just gonna say, so like, what are they doing it for is transacting. And then the question, of course, that can lead to a kind of shorter term or a long-term question. You can say like, well, short term, why are they going to keep transacting? Transacting is just basically you're using the network. And so short term, why are they going to keep transacting? Yeah, maybe it's because they're exploring NFTs, they're integrating it with their thing. Maybe it's because they're speculating. That's what it was recently, and that's probably what it's going to be for the near-term future. The difference would be before the merge, you're speculating and it's dilutive. There's no actual way that money comes back to you. After the merge, I mean, like there's lots of places where people make money from the act of speculation. So it's like if you go on to the Ethereum network and you use Uniswap, you pay a fee. It's not very different than kind of any platform where you use it to speculate on a market, and then the market maker makes money from you using the network, right? Longer term, of course, the nice thing about Ethereum is there are use cases that are being explored that are vastly farther than just speculation. And we can get into the effects of layer 2s and kind of where that kind of leads us as like a broader crypto use cases. But I think that's ultimately when you look at where does the money come from. Short term, you know that it's coming from the transactions. You can see that most of the transactions are speculative transactions. And then long term, you get a diversity of views on where people will use the network going forward and what that means. And that's, I mean, a lot of people have different views on that. To
be critical on this, let's look at this. Yeah, we have a leaderboard here.
Okay, so let's go 7 days. So just give my take on this. I think everything you guys said is true. I think there's a little more detail that you can go into. I think today, you can just look at the leaderboard. The fees come primarily from 4 places, what I'd say, 4 different categories. One would be NFTs, and that would be OpenSea, Gem, whatever random NFT mint happened to be minting at that time, ENS, etc. That's a large driver, and you can actually see down here they break it down. So this kind of answers the question for you. But I think about a third is from NFTs. Now the second third is what I would call token speculation. This is basically Uniswap, which is just, I'm going to trade XYZ token for other XYZ token. And a lot of this is like people trying to outperform ETH, and they'll buy a token. They think that that token versus ETH ratio will go up, and then they'll sell it for more.
So
ETH.
The first third is non-fungible token speculation. The second third is fungible token speculation.
Let's be very clear about one thing. Ethereum today is used primarily for speculation. Let's not beat around the bush here. Like that is just a reality. I don't think that's a problem. There's plenty of extremely profitable businesses that make all their money from speculation. I don't think that Ethereum will always be just used for speculation, but even if it was, I don't think that's a problem. But second of all, is that we are quite early in the adoption of Ethereum in terms of its use cases. And so yes, naturally, at the beginning, a lot of the utility is going to be speculative based. But yes, clearly, it's primarily used for speculation today. And then the other thing I would say is there's a lot of gas spent on what's here. Number 3 is ETH transfers. So that could be either payments or just moving things around. That's another large one. Stable coins would be another one. And you can see Tether and USDC. And those are like probably stickier kind of utility. And that Tether is the number 4 one on the list. So
I'm actually not familiar with this. How does Tether incur gas cost?
I think it's to do with minting and redeeming Tether and transferring it, et cetera.
So creating those tokens. Okay.
Same with USDC. And then lastly, the other one that I'd put on here is just other. Like there's always countless other things. Like you could go and you can find like, okay, these random contracts, like I don't know what these are. Arbitrum is an L2, STEPN is a game. Like, there's always gonna be random NFT mints. Yeah, random NFT mints, random L2s, this, that, the other thing. There's a good chunk of it that's just other, but that does actually speak to the breadth of the utility. Like there's always a ton of new stuff that's popping up and consuming gas. And it's not as fragile as you'd think, especially at these levels. Like even in the depths of the bear market, the blocks are always still full. People are always paying for gas. Yes, we're not doing $60 million a day, but we're always doing $1 or $2 million a day. So like there's a decent breadth to the activity, if not a great depth. That's what I'd say.
Nikhil, you were saying something?
Well, yeah, so I think the use cases change a lot week to week. Next week, you could have an NFT drop. It's like, I think part of it is the industry is going to be cyclical too. Like if you're a team and you're thinking about when to do an NFT drop, you're probably going to say, let's wait until we're clearly out of the bear market before we do our drop. Now is not the opportune moment. And so we're not seeing as much of that now, but I think on the flip side, I think we're likely to see a lot of cyclicality where it's just, as soon as there's a sign of this thing heating up again, people know what that looks like. They know there's opportunity, and it's gonna be like all in or not at all. And right now we're at the depths where it's like fees have been really, really low. Fees have been heating up a little bit. ETH price has been heating up a little bit. If we see that continue, it's likely that the fees will rocket up. And I think at any point in the future, if we see a persistent Ethereum rise, we're likely going to see models that look at fees today are going to underestimate fees and like by a lot.
Yeah.
So that's important to take into account.
Yeah, I would say there is a element of this self-reinforcing feedback loop in both directions, where price begets activity and activity begets price, and so on and so forth. And we have seen the early signs of price begetting activity. And there is a chance that if things maintain positive macro and the merge continues to fuel users and activity, that creates that self-reinforcing feedback loop where activity then begets further price and price begets further activity.
Just one point on the use case. I think it was very, very illuminating to go through the leaderboards there. I think there's a positive and negative view to take on that, and I think it's worth visiting both. Like the pessimist might look at that leaderboard and say, okay, you have non-fungible tokens, that third, fungible tokens is in the second, third, and a bunch of miscellaneous. So basically, Ethereum is just one big casino, and that would be the negative take. And that's worth addressing. Here's my alternate response to that. Yes, it is one big casino, but consider how superior Ethereum casino, as it currently stands, is to a standard casino. A standard casino requires you to take a flight to Las Vegas or Macau. It requires you to be over the age of 18 or 21, and it requires you to play a structurally loss probability game at the tables.
Yeah.
If you stay in the casino for infinity time, you're guaranteed to lose all of your capital.
And it's not that fun.
Yeah, and it's not that funny.
People might disagree with me. But I'll die on that hill. It's not that fun.
It's not fun for no reason other than the fact that you are guaranteed mathematically to lose your money by the end. Basically, that's how the casino is structured.
The Ethereum casino is legitimately fun to play.
And there's also just externalities like when people say it's kind of true. Like when people say an artist who is genuinely talented goes and makes an NFT and puts it on Ethereum, and then you speculate. You're absolutely speculating. But the thing you're speculating on, instead of it being like poker where it's just the money just goes to house, and that's kind of boring. Now you have an artist who just made like their year of profits. That's like pretty awesome. And like that's what I mean. Like there's use cases that tie things together in different ways where it's like, okay, like ultimately right now today, this is just speculation. Hopefully we can eventually get to a world where it's more than that. But even now, it's like, sure, the speculation is there, but we're speculating in a way that has very different effects than if you just go to a casino and put money into.
But I think the biggest thing is all those things are
game.
true. But the biggest thing is you can now play in a casino where the odds are not mathematically metered against you. You're playing in the world's first possibly positive sum casino if the value of the ecosystem is improving. And that
I would
by
just say
itself is like an infinitely superior like user experience than a classic casino. And I think that's why it draws roughly 10,000, 100,000 users and 200 billion to market cap, because it's like created this game, this new format that if you think about it, ranked against traditional gaming is just so superior, and it is, of course, everyone can.
And I would just say one thing. I agree with all that. I do think it diminishes the tech a bit though, to just say that like this is just a casino.
Of course. I think
just
to
touch on this really quickly. Yeah. Sure.
Exactly.
I think there are like a lot of other things that are being done here and can be done here that are not simply just like making a more fun version of something that exists. Like just very simply, global payments can't really occur any other way. I can send money to my friend in Indonesia in 5 seconds and no one can ever censor that. And that just exists on the internet. That is a truly profound tech innovation that only exists because of the blockchain.
Absolutely.
And like the other thing I'll just say on this really quickly, we could spend the whole podcast on this, but I don't want to get bogged down in it. But just the one quick thing I'd say is, to me, the true innovation or the true value killer app that blockchains provide is not actually just the decentralization of the blockchain itself. It's the interoperability that exists because of those core principles. It's the fact that everybody then trusts the network and builds their applications on a shared network, which then allows them to interoperate with each other much easier. That to me is a really profound point. I don't want to get into like all the applications to do with it because we'd spend the next 3 hours on it. But those two things to me are quite profound and kind of illustrate that, yes, right now it's being bootstrapped by the casino-like gambling speculation, but there is much more potential here long term.
But also, like, so I would say what you're saying is it's not that we like the fact that Ethereum is decentralized just for decentralization in itself, but that decentralization is valuable because of and like interoperability or whatever, security, whatever your value prop is.
Sure.
And the other thing I would just point out is it's not just bootstrapping. It's not like someone was like, oh, we're going to create a thing and cause people to speculate. It's not a coincidence. So you start by creating this decentralized network, and the fees are very high. And so if you're not going to transact with the intention of getting your values worth, like, are you really going to say I got $300 worth of value of sending like money from point A to point B if you're just a normal person? Like there are definitely some people transacting with, $60 million who are getting plenty of value for that. But for an average person, the best reason to spend $300 in fees in a transaction is because you think the speculative value is higher than that. Now, when fees change and go down, and that's where it goes back to the global payment service as kind of like a different use case, like we transition to like now, you can't just say I'm going to use it as a global payment service, but on an L2, you start to explore different use cases. And I do think, and this is like a broader thing we can go into later if you want, but just when costs come down with layer 2s, which is starting to happen, but really the focus moves there after the merge, it changes the incentive of of all the actors in the network, because now the costs are low enough that you can have higher frequency transaction, like you can create value in like frequent interactions with the network, where like we haven't talked this, but outside of speculation, a big piece of the value prop has always been store of value. It's just not, store of value isn't something that adds anything right now, because you're not paying fees for that constantly. We're just looking at where the fees come from. But when you have like much lower fees, you can do all sorts of weird things that it's not worth developing that right now when it's not practical.
Yeah, I agree with all of that. My point isn't that Ethereum is just a casino and always will be. My point was kind of like just to address the most pessimistic like perspective possible. You know, investors are always interested in a base case of what is the floor value? One way to interpret Ethereum today is that the floor value is it's a $200 billion market cap casino like operation that is permissionless and has a very fun positive sum characteristics that draws users from across the world, and that earns its current market cap. That's the floor price bear case for Ethereum. I think the bull case, of course, is the tech perspective. It's almost like AWS. It starts off with one service, which was S3, and now it has like hundreds of services, and it's now $1 billion like company on its own. So I think AWS, with its huge menu of use cases, is the bull case. And today we have this very, very narrow use case. But even then, that is the best version, I think, of that game that exists on planet Earth today. And that's why it's so popular. Anyway, let's move on. Onto the trade mechanism. Obviously heading to the merge, you can long ETH, but Hal, I think you've expressed repeatedly that ETH BTC is perhaps even more of a like stronger expression of what's like you can bet on. How do you think about like what are the different ways today that's the best way to get exposure to this thesis?
Yeah, sure. It's a great question, and it's like I'm quite an obsessive person and personality. So like when I think about something, I generally think about it every waking minute. And this is one of those things that my brain just constantly churns. So I've thought about this question as to what is the best way to express this trade in great depth. Whether I've come to the right answer or not is another question, but I've certainly thought about it a lot. I think obviously the easy answer is just long ETH, and as a fund manager, the fund is very long ETH. We have a large long ETH position. In addition, there's a couple other things that you can do that I think are potentially a higher Sharpe ratio. It's not a question of just what's going to have a greater return. It's really trying to maximize for that Sharpe ratio of returns versus risk. And to me, if you're trying to optimize for Sharpe ratio, ETH BTC is really the single best way to express the trade. And I said that I said that in July before ETH BTC started moving, when it was like 0.055. That's when we accumulated the vast majority of our position. And I still believe that today. The reason, and just to articulate on what's happened so far, like you can kind of see this happening a bit. In the last month, like Bitcoin has barely moved. Like Bitcoin was 24K like 3 weeks ago, and today it's still 24K. And ETH is up 30+% over that time period. Like some kind of a shocking thing. The fund has had on the ETH BTC trade since June. I've traded around it a little bit and generated some alpha here and there. We are up on the short leg. Like our net BTC P&L is positive. And obviously our ETH P&L is very positive, but like our BTC leg alone is not very positive. It's like very close to break even, but it is actually positive, which is like kind of illustrates the value of this. You've been able to eliminate the entire macro risk for nothing, zero cost. I've actually made money on the trade. And the reason, well, that's Bitcoin is up a little bit over that time period. So like the trading round that I've done has generated some of that, but it's up very little. The reason, like the reason that's so valuable is because that's allowed me to express the trade in much greater size. Like if the only instrument I could have to long ETH was ETH, I probably would only put like 60-65% of the fund in it or so. But because I have this other instrument, I've been able to put like 60% of the fund long ETH and another 30% of the fund just in long ETH BTC, which actually gives me 90% exposure to ETH with a and then that extra 30% that's expressed as ETH BTC has performed almost exactly as well as the other ETH. So it's given me the freedom to be bigger in the trade because I'm expressing it in this higher Sharpe ratio form. Now, so that's kind of just like backwards looking though. That's not like, I mean, that doesn't really help us.
But it's also, I mean, if I could just interject real quick, it's not just that it's higher Sharpe ratio because it takes out the macro risk. I mean, that's a huge thing. I completely agree. Because last time we talked about this, a lot of our discussion was like, sure, we all agree we like Ethereum, but we're like worried in the middle of this crazy volatile market about the timing of it and the macro, right. You just kind of cut that out. But I think the other thing is we spent all this time talking about how Bitcoin and every other crypto asset is a structural like supply asset, and that Ethereum is going to become a structural demand asset. And so if you just long Ethereum, you get the structural demand. But if you long Ethereum and short the structural supply asset, now you get both, right? You get to make money on Bitcoin expenses and make money on Ethereum revenue at the same time. Right. So you actually, it's not just lower risk, but it's higher reward too, right?
Yeah. So what you're touching on is the thesis. So what I talked about was just the performance of it, and kind of like from like a technical like risk management perspective. But I think, if you want to get into the thesis, it's extremely interesting. Like I think there's the obvious thesis, which we talked about, which is just like the flows that you said, like after the merge, ETH's gonna have structural demand, Bitcoin's gonna have structural supply. ETH will have a time tailwind, Bitcoin will have a time headwind. You just sit there for long enough in those two, all else equal, you should just collect money on both legs as time passes. And that's a favorable dynamic. But there's a lot more to it, in my opinion, than that. To really break down why gets into a little bit of a larger discussion about proof of stake versus proof of work and ETH versus Bitcoin more generally. And I guess like I would like to discuss this. I'd like to first preface it with the fact that I probably come off as like a diehard ETH maxi. And what I would say is, from an investing standpoint, I have been an ETH maxi and continue to be an ETH maxi. But from a fundamental perspective, I am by no means an ETH maxi. Like I am quite open-minded about which thing theoretically makes more sense. Now, I happen to believe that proof of stake is superior, but I'm very open to this discussion. And I don't think of myself as kind of like an ETH maxi from a theoretical perspective. Like I talked about a little bit in the past, is like you have to be able to separate investing in the token from believing in the network, and they're not totally the same. So from an investment perspective, I'm an ETH maxi. From a tech perspective, I'm not necessarily an ETH maxi. So what I would say, just with that preface, is, okay, so to start, I think you really first have to dial into the fundamentals of proof of stake versus proof of work. And I think, we can talk about these things as a utility, but that's kind of a very straightforward discussion, right? Because Bitcoin doesn't really have any utility, and ETH has quite a bit of utility. So there's not really like a comparison there. I don't think anyone, even from the Bitcoin maximalist camp, would say, oh, we like Bitcoin because it's a better utility than ETH. I think the relevant discussion is about the store value. And so to get into that, you really have to look at, okay, what are the characteristics of a successful store of value? And how do these two assets stack up on them? And I think there's really two things that matter most in my book. One is security. You need to know that the asset will exist under any adverse scenario in the future. That's the whole point that you have money in it in the first place, is to store value against those tail outcomes. That is literally the objective of the asset. And then the second is credible neutrality. And that kind of fits into the first. But I think about it slightly differently. You need to know that there is no party that can influence this asset or control it or censor it in any way. And so I think those are the two variables that I think are really interesting to discuss. So then just to start, and I'll just like kind of lay out some basic thoughts and then we can dive into it. On the security topic, in my opinion, proof of stake is just orders of magnitude more appealing than proof of work. And the reason for that is, okay, so first of all, at the very basic level, you think, okay, how do you measure security? What is security? So security for these consensus mechanisms is the protection and the defense against a 51% attack. That's ultimately what it comes down to. Like for gold, which has been by far the best store value historically, the security is just that it's a physical thing that exists and it will never stop existing. Like that is its security. But for these, they're not. So what is the security? The security is their ability to remain in existence and secure. And that comes from the ability to protect against the 51% attack primarily. And so, okay, where does that defense come from? So for each system, to 51% attack it, you need to control 51% of the voting power, which in the case of proof of work comes from mining and the proof of stake comes from staking. So you need to either control 51% of the hash rate or 51% of the staking participation. So then you start to think about, okay, how much does it cost these networks to generate their security? And then you start to be able to think about the efficiency of it and which is superior in terms of generating that security. And so for proof of work, the security comes from, like I said, the hash rate. So to think about how efficient that security is, you have to think about how much does the network have to issue in order to purchase a unit of security. So if we just talk about dollars, how many dollars must Bitcoin issue to generate $1 of mining security? And so what you have to look at is, okay, how do you attack it? You attack it by generating the hash rate yourself in purchasing it. So then the cost to attack it is the cost to buy all the hash rate that exists. And basically, like if there's X gigahashes, you need to buy X gigahashes so that you control just as much, and then a little bit more, so you're 51. So the cost to do that is the cost of buying the mining equipment. So you have to then the next step in the equation becomes, okay, how much hash is there, and where what controls that variable, which boils down to how much of a return do miners require on the money they spend on hash rate to spend that money on hash rate, because that's ultimately what determines how much money is required to equal their hash rate. How much must I spend to equal their hash rate? And so the answer to that question is generally miners will require a 100% annual return on their investment. So if they're going to go buy a bunch of mining rigs, and this is like an oversimplification, but it's roughly in this order of magnitude. If these miners are going to go spend $100 to buy a mining rig, they will only do so, and electricity and everything else, et cetera, et cetera, et cetera. They will only do so if their rate of return is $100 a year. And so what that means is that Bitcoin must pay $1 per year for each dollar of security that it generates. So if it wants to have security against a $5 billion attack and make it such that an attacker would need to spend $5 billion to attack it, it must emit $5 billion of Bitcoin annually to get there. So that's where we are with proof of work. It's about a 1-to-1 ratio. Now, with proof of stake, the mechanism is obviously a bit different. It comes from the staking participation versus the mining participation. And so it's actually quite a bit simpler. It comes down to what is the return that stakers demand in order to lock up their ETH in the staking contract and not use it elsewhere. And in the case of ETH, that case, or in the case of proof of stake in general, that return is roughly between 3 and 10%. For ETH right now, it's about 5%, so we can use that 5%. So it's about 5% return. So that means for me to lock my ETH, I will demand 5% return on that. That compares to the 100x, or sorry, the 100% return that Bitcoin miners demanded on their investment. So it's the relevant comparison is a 5% required return versus 100% required return. And so what that ultimately means is that for ETH to generate $1 of security, they must pay out 5% of that dollar each year, which is about 5 cents. So when a Bitcoin network needs to pay $1 for $1, a proof of stake or Ethereum network needs to pay 5 cents for the dollar. So it is approximately 20 times as efficient in terms of its security generation. So just for that very fundamental reason, like proof of stake is way, 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 way more efficient in the security it generates and therefore secure than proof of work networks. And it comes from the fact that you don't require all this unnecessary mining to solve this arbitrary hash, et cetera. That's like the fundamental actual breakdown at a first principles level of why it is more efficient. But then there's actually a few more steps, and we'll just touch on security, and then we can go to credible neutrality next. But the other point, which I think is kind of really less understood and less discussed, is that it's also much more secure against attacks, efficiency aside. Even if you assume they have the same security budget, like let's say that Ethereum is spending $1, but Bitcoin is spending $20, and so therefore, because Bitcoin is 20 times less efficient, they're generating the same security. It's still a lot easier to attack Bitcoin than Ethereum. And to understand this, you have to understand like actually why or how what is the attack vector? An attack vector for Bitcoin is buying up a bunch of hash rate and putting it on the network and controlling the hash rate. The attack vector for ETH is actually buying the tokens. And what the difference there is that with each token you purchase, the next token becomes harder to purchase. And every token after that becomes harder and harder and harder. And there's actually only so many tokens you can purchase. So if you imagine, for example, that 51% of ETH is staked honestly, it is then mathematically impossible to attack the network because there's not enough tokens that exist to get 51%. They don't exist. It's a finite number. Whereas for Bitcoin, every mining rig that you purchase, you buy them from NVIDIA. NVIDIA makes a lot more than they just send to, or in the case of Bitcoin, it's not NVIDIA, it's Bitmain. But you buy them from Bitmain, they can sell you as many as they want. Like it's not, there's no relationship between how many you've purchased and how hard it is to purchase the next one. And there might be like a small one based off like global economy, but it's much, 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 much less direct. And so that actually, that fundamental difference makes proof of stake much more secure for that reason. And then the other point where that's actually really relevant is because these networks have a problem, which is that for the most part, their security is directly tied to the value of their token. So because their issuance is issued in tokens. And so as the price of the token declines, so does the security of the network, because those sustaining it are getting paid less and are therefore willing to pay less to sustain it. And so it therefore becomes easier to attack. And this is actually a very bad problem because it creates this potential for a negative self-reinforcing feedback loop where the network becomes cheaper for some reason, or the tokens become cheaper for some reason. This then negatively affects security, which therefore hurts confidence in the system, which therefore further causes price declines, which therefore further impacts security, and so on and so forth. You can create this negative spiral effect if things ever get too low, where all of a sudden it then becomes very obvious that someone's going to attack the network, so everyone sells, and then someone attacks it, and the network's dead. So with proof of stake, however, there's a natural defense against that, which is that the limiting factor to attack the network, if it reaches this optimal point, is no longer dollars. It's not how much money does it cost. It's how many tokens can you buy, and whether the tokens cost $10 or $10 million. If there's not enough of them in the liquid supply, you can't get them. It doesn't matter. It's not about money. It's just that they don't exist. Now with mining, that's not the case. If the network, if the tokens go down a lot and therefore the hash rate goes down a lot, it's much easier to just buy fewer hardware machines and mine the necessary amount. So they don't have this reflexive, like proof of work does not have that reflexive defense system, and proof of stake does, where proof of stake, if it gets to this optimal point, or even if it doesn't, it still is, it's much less price elastic. And so it doesn't really matter what the price does so much, because it's more a question of just buying enough liquid supply. And I would say for the case of Ethereum, only 1/3 of the supply actually is liquid. Only 1/3 moves every 3 months. And so like, if we get to a point, which I think we will quite quickly, where 30% of ETH is staked, it's basically impossible to attack. There is not enough liquid supply to do it. Doesn't matter how low the price goes. It's not about money at that point. It's just about the number of liquid tokens. So for all of those reasons, it's quite obvious to me that proof of stake is just fundamentally a more secure mechanism. And for that reason, I think in that category, Ethereum is clearly the winner. And actually not today, obviously, because they haven't merged and they're still using proof of work, but post-merge. And that's why the merge is such a fundamental catalyst for this discussion. It's like, yes, there's the flows and the merge sparks that, but there's also all these fundamental things that happen. And I think that's also why it's such an important catalyst, is like, it's not like a Bitcoin halving, because a Bitcoin halving is like, okay, the supply gets reduced, but oh, by the way, we're also having the security budget. So it's a flow positive, but a fundamental negative. And it just so happens that the flow positive is usually outweighing the fundamental negative. This is like, okay, it's going to be 3 Bitcoin halvings at once, and it's a massive fundamental tailwind. So it's like, there's no like offset here. They're both pushing in the same direction and they're both very relevant. So that's why, like, I'm done now. I'll let you speak. But that's ultimately why I think that's like such a profound moment, and why I think the proof of stake network ultimately wins on security.
Well, and that was really great. And I wanted to connect that because we were saying initially, and I do believe this, but ultimately it's about how the fundamentals affect the flows. And I think there's a long-term argument to be made that in the long term, people will prefer the security, like a higher security network, a better decentralized network, a more credibly neutral network, as you're going to get to. But I also think there's interesting things kind of and we don't have to spend too much time on this, but interesting in the current environment where you have a lot of attention being paid to things like the cost of electricity and the climate effects of these things. And when you talk about security being less expensive, you're also talking about things that in a like regulatory environment start to feel safer as well. And so I think it's not just long-term flows, I think short-term flows too. Like if we start to have intensifying discussions about the regulation of like Bitcoin mining because of its energy use or something like that, what does that mean? Again, it's just another ETH BTC trade where we're going to see people moving from the assets that are most under pressure to the assets that are most defensible under that argument. And I think that kind of all those energy use kind of conversations, they just map directly onto the security, because that is what is producing security. It's the difference. And so anyways, I do think that it's like a long-term flows thing, but it's also a short-term flows thing too. I just thought that was kind of worth pointing out.
So
I think that's all fair. And I don't know if James, you want to comment on that. But when we're done with this, I think the next topic that we should go to is the credible neutrality, because I think it's not fair to, like, I think Bitcoin is currently winning that discussion. And I think it is relevant to discuss that.
I guess just to structure this, both of these points, I think, is it the case that you're using both of these points to argue that long-term ETH is the better store value, like even on the money front, it is a superior instrument?
Yes, so I think ETH take flows entirely out of the debate. I think right now, if you look at the crypto ecosystem and you say which asset has the best chance to actually be a store of value long-term, I think ETH is better than Bitcoin. I think in its current form, actually neither asset is good enough, and I think that's why. A strong point. And I think right now that's why neither asset has actually been adopted as a store of value. Bitcoin has not functioned as a store of value. Like you're not supposed to go down 70% in a bear market when all of macro is crashing if you're a store of value. Gold didn't go down 70%. Bitcoin is traded as a risk asset, just like every other crypto asset. It's not been a successful store of value. That's why it hasn't been adopted as one. So neither asset is a store of value today. But if we want to then discuss a more interesting point of which one could actually become a store of value someday, to me, this is just my opinion, Ethereum is better suited for that. And so we talked a bit about the security. I think it is important to talk about the second point, which I highlighted, which was the credible neutrality. And I think that this is another very relevant one. And I think credible neutrality ends up having a lot to do with decentralization ultimately. But I think, so really it comes down to how decentralized is the network. Like I think an accurate and common criticism of Ethereum today is that it is more centralized than Bitcoin. And that is just a fact. It is. There is a core developer group that has an active role on Ethereum. Now, there are also like quite a few core programmers on the Bitcoin side. I don't think people really know this. Like most of Bitcoin sort of code updates and things of that nature come from the same few developers. So there is like a group of core developers that work on it too, but they have a much less meaningful impact because Bitcoin is largely ossified as a protocol. So it doesn't actually change that much. So yes, Ethereum does have a larger centralization weakness today. However, I think there's two things here. There's the developer ecosystem, and then there's the decentralization of the actual consensus mechanism. So if we just for a second focus on the developer ecosystem, yes, Ethereum is more centralized today. However, in my opinion, and I've spoken to a lot of developers about this, and so I know they share this same view, Ethereum is not in its end state, but it's much more interesting to look at things in their potential end state than in their current state. Long term, like Ethereum is on a roadmap. It has a roadmap, and Vitalik has talked about this a lot. But we're in the middle of the roadmap. We're not at the end of the roadmap. It's not done yet. But someday it will be done. There will be a day. And I think the view on this from developers is that it's probably going to take somewhere between 8 and 12 years, like around 10. But in 10 years, we will get to a point where it is basically done. And then the developers
for 1 second.
Yeah, you can.
Every software platform has a roadmap. And then once they're done with the existing roadmap, they add more to the roadmap. Like the goal is to make the thing bigger and better forever. Why would Ethereum magically terminate in 10 years?
Right. So I think that's a relevant concern. I think the answer is, like we talked about with the fees discussion, it's like a function, right? Where the advantage of X versus the disadvantage of Y, and there's a utility function where there's an optimal point. And I think there's a set number of things that are like so mission critical that the developer team must get them done and is willing to sacrifice centralization in order to get them done. But then you reach a point, and of course things can change, but you reach a point where the incremental return is actually not that great, and the cost of remaining centralized outweighs that incremental return. And so it's not that I think the developer team will ever like cease to exist. Like I said, there's a developer team for Bitcoin too. It's that I think their importance will fade quite dramatically, where it will become more of like a crowdsourced maintenance team than actually a core developer team that's pushing real protocol upgrades with aggressive sort of process like we're doing with the merge. And that's ultimately then saying, it's not that I think like there will be no developer team, like of course there will be, but like their relevance will be much less significant. And importantly, when that's the case, it becomes way more credibly neutral, because at that point, a government like the US government can say, okay, we've got the devs, like we're holding them hostage, like shut down the network or else we're gonna do something. We're gonna kill Vitalik. And at that point, like if it's truly just a maintenance thing, they'll have no leverage. Like, okay, the network still runs. It's no longer like, all right, I think already the network doesn't rely on Vitalik. And I think like he's obviously pretty happy about that. But I think way so more in the future, like more in the future, this will be way more the case. The network will rely very little
right now,
on the actual developers team.
It's like right now, it's like if that happened, if someone was like, I'm going to apply leverage to the dev team, it is a problem because we could say, well, okay, the network still runs, it is decentralized, but maybe now we can't get proof of stake, or if it's after the merge, now we can't get sharding, and the network isn't going to be as useful without that.
Okay,
So that's
I buy that. I think there are a few examples of things that are pretty large scale. Software-wise, it gets built out and then becomes kind of like log change over time. Even Facebook itself. Facebook itself started off as a directory of your dorm room and your like contact information, and then it did this huge change into a timeline, and then it pivoted multiple times. But if you look at the change over time, Facebook today looks a lot closer to Facebook 5 years ago than Facebook 5 years ago from when they launched.
So
a
yeah,
pretty large service can definitely like asymptote over time.
right. So my point is really just that, like, I don't think Ethereum will, like I said, like you can split this credible neutrality into two parts. It's the developer ecosystem and then the actual consensus mechanism. On the developer ecosystem, I don't think Ethereum will ever surpass Bitcoin. Like Bitcoin is kind of like the gold standard on that, but I think Ethereum can get to a point where it's close to on par, and it is clearly credibly neutral in that, and anybody trying to attack the network won't have any leverage. So for all intents and purposes, it's just as good. And then the next part becomes, okay, the consensus. Like if you take that for a given, obviously people might disagree, but like if we just move on from that, the second part is about the consensus mechanism itself and how decentralized it is. I think here there's an obvious advantage for proof of stake. The problem with proof of work is that it benefits tremendously from economies of scale. One of the largest input costs is electricity, which is much cheaper the bigger scale that you use it on. And so that's just that simple fact that proof of work costs so much more, and there is such a greater benefit of economies of scale, creates a much higher degree of centralization in those that maintain the consensus mechanism. So today, 70% of all Bitcoin mining is done by the top 5 mining groups. If you look at the top 5 holders of Ethereum, they only own like 3% of ETH or something. So just structurally, proof of stake is a far more, it has far greater or has far fewer incentives for centralization of the actual consensus mechanism than proof of work. I think the only pushback that you would get for this is that the liquid staking derivatives and those liquid staking protocols create some level of centralization. And I think that is fair. Like if you look at it today, and we should, I think we may get to this topic next, but like Lido controls 30% of all the stake. I think that is true, but I think that there's two things that I would say that kind of reduce the risks around that. And again, this is not to say that there aren't any risks and they of course should be dealt with, but first of all, it's not as if Lido directly controls that stake, right? Like they just have some ability to try to influence the decisions of the validators that ultimately do the staking for them. But ultimately those decisions are up to the validators, not Lido. And then second of all, I think that there's a lot of other sort of risk guards that can be put in place and a lot further decentralization that could potentially happen within those liquid staking derivatives to further guard against this. So I think that's probably the main pushback that you would get. And my comment would be long-term, I don't really think it's that big of a problem to begin with, but even though it isn't, there are likely going to be further defense mechanisms built in to protect against it. So basically to summarize, on security, it's very obvious to me that Ethereum is the better bet, just mainly because proof of stake is much more secure for a variety of fundamental reasons. So that's point one. And then point two, on credible neutrality, on the developer ecosystem, Ethereum is clearly lagging today, but in my opinion, in the future can get to a point where it's roughly on par. And then on the other side of credible neutrality about the actual mechanism, again, clearly obvious to me that proof of stake is superior. So like if you're trying to just like overall weight it, I think it's not particularly close in my opinion.
Now, what is when you make these 2 points, what is it that, with what end are you arguing towards? Is it a very, very long-term thesis? Is it the merge thesis? What are you arguing for?
Yeah, so what I would say is, and that point I just made is not a comment about the networks today. Again, Ethereum is not there yet, but neither is Bitcoin. This is a comment about what the end states look like. And so to get to your question about the trade time horizon, I think this is a long-term trade. Like it's not as if the merge is going to happen and everybody that thinks of Bitcoin as a store of value is going to go, oh, well, now Ethereum is a better store of value. I got to buy Ethereum instead of Bitcoin. That's the opposite happen. This is going to take a long time to play out. But I think the merge is a really big step because of the natural advantages of proof of stake to get people thinking about this and get people questioning, what actually is the best store of value and why is that? And, how do these things actually stack up long term? So what I'd say is it's a very long-term trade, but we're at a critical juncture of that trade where, like a trade like this, it's not going to happen just in like a straight line, just like constantly over time. It's going to be a lot of chop, and then there's going to be large periods of movement and then further chop. And I think we're at one of those large periods of movement.
When you say very long-term trade, how long are we talking here?
It's a good question, and what I would say is, the further out in the future we go, the less confident I am in my ability to predict things. So if we start getting into those longer term debates, like it's just much harder. Like I can give you a view, but it's just much less, I have much less conviction in it. So I would say eventually, but trying to predict if that's like 5 years out or 10 years out or 15 years out is just extremely hard. And the reality is, I don't need to know the answer to that. Like I can just take things 1 year at a time as an investor and constantly reposition accordingly. And that's kind of how I operate. But if you put a gun to my head and said, okay, I don't care about that, you just like have to pick, I'd guess within the next year or two, Ethereum will probably flip Bitcoin and become the largest token. But that doesn't mean that it will win the store value debate. I think the store of value, like I think Bitcoin will continue on as just like a commonly used or thought of store value. I think that debate will probably take more like on the order of 5 to 10 years.
Do you think the best store of value token should have lower volatility by definition?
That's another interesting topic, and thank you for bringing it up. This is something I've thought about a little bit, and I think, yeah, is really, I've not heard anybody else discuss, but another reason why the merge should help the Ethereum case is that, yes, I do think that store value should have as low volatility as possible. That's literally the purpose of the asset, is to be a store of value. So to not move very much, just keeps the value solidly stored. That's what gold does. When things are crashing, it's stable. When things are ripping, it's also stable. It's just stable. So yes, dampened volatility is a big positive for store values. And I do think, obviously, today, as the smaller asset, as the younger asset, Ethereum is more volatile than Bitcoin. But I don't think that always has to be the case. And I think that the merge specifically should actually help reduce volatility, because just that structural shift from structural supply to structural demand is actually quite relevant towards generating stability in the times that you actually need it. So when we're in a crash, if you have a system with structural supply, it's like, okay, everyone's selling. And on top of that, the structural sellers are also selling. So it just exacerbates the volatility. But if you have structural demand, it's like, okay, yes, everyone's selling, but there's this force that's there every day, absorbing some of that sell pressure, offsetting it, and dampening the volatility when the volatility actually requires dampening. And that, I think, so when Ethereum does go to that structural demand, I think you might see that, where in these volatile periods, especially as a real yield asset, people gravitate towards it, and it has structural demand, and so it actually experiences lower volatility around those sharp sell-offs, and that will go a long way towards proving it out as a successful store of value.
So can I kind of interject, because I have a different view on that. Okay, so I think we were talking about the idea of flows. You have structural, right now you have structural sellers, and whatever price is, you have the equivalent number of structural buyers. And I think that what we're going to see after the merge, when you take out those sellers, is a lot of volatility, and specifically volatility to the upside. And that's because my view of what volatility, where it comes from, is if the price has to go from 1,000 to 1,001 to get all the supply you need to match those sellers that are just removed, you have very low volatility. But if the price needs to go from 1,000 all the way up to 2,000, you have a lot of more volatility. And so where you see price right now is at, quote unquote equilibrium. When you take this dramatic change with the merge, it'll have a short period of time where the market's in disequilibrium and it has to move a lot in order to replace all that structural supply. But then, so the question then is like long-term, like 5, 10 years out of the merge, where's volatility come from? And it's all about just like how minute can we get, how granular can we change supply? I think that this is where layer twos come in, where if people are able to transact Ethereum in small amounts constantly and use it more like a currency, like there's a reason that US dollar and the yen have very low volatility. That's because the most of the supply and demand don't come from speculating on price. If you just want to create supply, you get it from someone who's selling it for a completely different reason. They're using something on the network, or they're like taking the proceeds from something that's still on network. So I think when you have layer twos reduce the fees and people are transacting at 0.01 ETH way more often, you're going to see a dramatic reduction in volatility suddenly. Because when I want to go buy, a small amount of ETH, price doesn't have to rise that much to get me that ETH. And similarly, if I want to go sell it, price doesn't have to fall that much to get me a buyer. But so my take is that it's not even, I think the merge is going to cause volatility short term. I'm kind of neutral to the merge and how it affects volatility long term. I think long term, layer twos are going to dampen volatility dramatically in a way that Bitcoin just can't have. And so I don't know. We'll see. I mean, it's interesting. I think it'll be interesting to see also what that means for that's a big transition for the network, because if we're saying a lot of the fees right now come from speculating on the network, a lot of that comes from volatility, right? And so what I'm also arguing for is this Ethereum is going to need to transition somewhere for its major use case if the volatility dampens, which is a kind of an interesting kind of side thought.
On this point, I mean, if it really, both of you are arguing that over time Ethereum volatility should decrease. I've always had this problem. Like, doesn't this, if an asset is a wonderful asset for store value, by definition, it is less wonderful as a growth asset. So how can it be both optimally? It can't be. So if after this transition, you're saying volatility is going to go down, I don't know what is the time period you measure your Sharp, but if it's very good store value, it's not going up a lot very quickly, at least. How do you square the two?
I'd say two things. First of all, I agree with Nikhil. Around the merge, obviously volatility will be anything but suppressed. It's going to be a risk event that will have very big moves. I mean, that's obviously true. But I think more what we're talking about, which you also agree with, is that longer term the impact should be volatility dilutive. So in answer to James' question, I'm not arguing that it will decrease the size of the longer term moves. I'm saying on a day-to-day basis, especially around periods of sharp downside volatility, it should soften the blow. It's probably more about specifically downside volatility. However, so it's you can have an asset that grinds up 15% a year. I'm not saying this is what ETH is going to do. I'm saying in theory, you could have this asset that exists, grinds up 15% a year. That's an amazing store value. It's very stable, and it grows 15% a year. That's extremely good return. That's a growth asset too. So they're not mutually exclusive. But
I guess it's more. Okay.
But I think you're right though that to some degree,
I was going to say,
as long as there's growth prospects, as long as Ethereum has growth prospects that are worth speculating on, it's going to have volatility to the downside because people are going to overprice it. They're going to say, oh, it's worth a lot, and bid it up. And then because they bid it up so high, it's going to fall more than it should because the supply comes from the people who leverage buy the ETH when there's no reason to do that for US dollars,
I was going to say, I think Ethereum will remain interesting for a long time. And I think so long as it remains interesting, it will likely also remain volatile. And so I'm not predicting that Ethereum will just become some sleepy, boring, grind up into the right S&P style asset. But I'm just saying, if you just want to look in theory at the impact of the merge in isolation, it should dampen downside volatility. That's all I'm trying to say. And then,
what do you think about crypto cycles? People argue about, does the halving bring the crypto cycle and stuff?
That's a very, very relevant discussion. I think we could spend the entire podcast on it. We only have 30 minutes left. I think we did. There's one other topic we wanted to hit on, which was the other trade idea was the liquid staking protocols. Nikhil, I know you have a view on this.
Love this. I love LSD.
I coined the
only one kind.
Yeah, I don't do drugs, so this is the only LSD I do. But Nikhil, I know you have views on this, so if you want to kick us off, go ahead.
Sure. Yeah. So I have made the case before for, well, it's actually kind of already played out right now for what's called the staking arbitrage play. And it's basically the argument that these staking derivatives, they have the staking yield of Ethereum, but they allow you to isolate the risk. So you can, if you buy, ST ETH from Lido, R ETH from Rocket Pool, or whatever your staking derivative of choice, then you retain the rights to your one ETH, but you also now have this like payoff in terms of the yield over time. And so that allows for all sorts of interesting things where you can buy that ETH and short ETH elsewhere, or kind of however you want to structure it, your risk. And so we've seen actually, because before the merge, this is not very risk-free. Before the merge, if you buy ST ETH and it depegs, like you can't get your ETH back. And so we've seen, the ST ETH, there was a period maybe a month or two ago where the ST ETH depeg was a big topic of conversation. And I think that's already evidence that that trade, if it can exist before the merge, it's going to exist after the merge. And the only limit is going to be how big the yield gets. And so this is an arbitrage trade. If the yield is 1%, it's not a very attractive arbitrage and very little will be staked. But if the yield starts to really increase as price increases and we get this upcycle and we see like a 10% yield, basically as many people who can stake will stake, not because they're just going to be like speculating on the price of ETH, but because buying a 10% yield and hedging off the Ethereum risk is well worth the risk of like the Ethereum protocol, which Hal has argued is very secure, and I agree with. And so I think that what that means is a lot of Ethereum is going to be staked, and exactly how much is going to vary with how much yield there is. But if you just start looking at the Ethereum float, and I think Hal said, you said it was like 70% of the ETH hasn't moved.
Yeah, in the
right?
last 3 months.
So, right. And so if you assume that a significant amount is going to be staked, it at the very worst means that it ossifies that 70% of the float. It means that float is not just people who are really strong about not selling. Now they're going to actually stake it and commit to not selling. Or it actually moves marginally, where some of that ETH is coming from ETH that is moving into Ethereum that's not moving. And that's a big deal when you think,
right,
okay, all of this comes back to when I buy Ethereum to pay fees, who do I buy from? And if there's no buyers, price has to move up. Well, this argues that staking is going to make it harder to find ETH to buy.
Right. I think that's all relevant to the kind of like the staking dynamics and how the participation plays out post-merge. I think the other relevant topic to discuss is the actual value of the tokens of those protocols. I have had a thesis for a while. It's not a unique thesis. Other people have shared this thesis that the liquid staking derivative protocols, I will call them LSD protocols. This is an easier abbreviation than constantly saying that word full. So the LSD protocols are one of the largest beneficiaries of the merge. And in my opinion, I told you I think about this a lot, they're actually the single largest. I think they directly, well, actually, okay. To understand why that is the case, it is necessary and relevant to first understand how do they actually make money and what do they actually spend money on. So the way that these protocols generally make money, and I'll use the case of Lido because Lido is the largest one and it's the one that I probably know the details of the best. But this is also applicable to many of the others. When Lido issues ST ETH, the person who gives them their ETH and receives the ST ETH forfeits 10% of the staking reward. So if the staking reward is 5%, staker is willing to accept only 4%, and they will give, or sorry, 4.5%, and they will give up 50 bips to Lido. Now Lido then takes half of the 50 bips, so 25 bips, or 5% of the total, and they keep their 5%, and the other 5% they give to the validator that does the staking for them. So they generate 5% of all rewards issued on their LSDs. That is where the revenue comes from. So it is a function of simply one thing, which is how much revenue or how many rewards are being issued off of their LSD products. Now, their expense, they have multiple expenses, but their largest expense currently is that they have to incentivize liquidity between their LSD and native ETH. And that is a very important thing because the whole point of the liquid staking derivative is that it is very liquid and it can essentially be replaced for ETH at any time. That is the reason that you have it. And so that liquidity is extremely important, especially for larger institutional accounts that have a lot of ETH and want to be able to stake it. So they end up paying a lot, on the order of like 80% of their issuance goes towards maintaining this deep liquidity between their LSD and native ETH. Okay, so that's their revenue and expenses. They generate revenue from staking rewards and they pay it out to maintain this liquidity. Primarily, they also have to pay out to like maintain liquidity of their native token, etc. But like, I mean, Lido versus ETH, etc. Post merge. Okay. So before we get to post merge, their revenue as a function of staking rewards. Staking rewards is a function of 4 variables. I think this, I might be fuzzy, but I think it's 4 variables. Okay. 1, price of ETH. 2, and this is obviously I'm using the case of ETH, but this Lido, it doesn't just do liquid staking for ETH, it also does it for other networks, and the same things apply there. But for ETH, it's price of ETH, staking participation of ETH, staking rate of ETH, and market share of liquid staking derivatives. Those are the 4 variables that impact their revenue. The market share variable we can eliminate for now because the merge has no impact on. The other 3 variables, the merge has a direct impact on. ETH price, we've already articulated the case for why we think ETH price should be impacted. ETH staking rate, we've already said, is going to increase from 4 to 5% roughly, so that's a 25% increase. And ETH staking participation is probably the largest, is going to really increase post-merge because A, the staking rate will be higher, but B, more so, it will be massively de-risked because it will already be proof of stake and withdrawals will be soon on the horizon. So I would expect like the staking participation rate to increase somewhere from around 12% to, over the course of a year, maybe 30%. So you're going to have a 250% increase in your staking participation rate. You're going to have a 25% increase in your staking rate. And because it's the example I've used in the past, I'm not saying this is what's going to happen, but let's just assume ETH price appreciates 50% for this example. So you have 50%, 25%, and 150% in terms of your increases. Those are the things that impact the revenue of the liquid staking derivatives. And importantly, those are not additive, but they're multiplicative. So they all compound each other. So the net effect of those, I know because I just wrote it up in my piece, is actually a 440% increase of the revenue of these liquid staking derivatives. So they generate their revenue is directly proportional to the price of ETH. So any improvement that ETH's going to get from the merge, they also get. And then they have these 2 added tailwinds from the staking participation going up and the staking rate going up that compound that price increase. So their revenue up 440%.
That
now,
all sounds. Go ahead.
Their expenses, we're not done yet. It gets better. Their primary expense, it sounds actually a lot like the merge. Revenue up, expenses down. Although the merge has a very limited impact on revenue. I do think it'll have some revenue impact as activity comes back. But their biggest expense is incentivizing the liquidity between their native token and the native ETH token, like their LSD and ETH. Post-merge, there's actually no impact on this, but the merge, what it does is it provides the runway to withdrawals shortly thereafter, 6 to 9 months. And post-withdrawals, their revenue, that expense will go close to 0. Because once you're able to withdraw your staked ETH, then all of a sudden you will be able to redeem STETH for ETH 1-to-1, and there will be a natural arbitrage. So anytime STETH depegs, an arbitrager will simply buy it, enter it into the redemption, wait 21 days or however long it is, and get the regular ETH back. And there will be almost infinite bid for depegged LSDs. And this will essentially remove the need for these protocols to issue any supply to create that liquidity. So around and after the merge with withdrawals, you'll have a roughly 400% increase in revenue. And let's be conservative, 60% reduction in expenses. So that is the case for why they should outperform ETH. They should benefit any amount that ETH benefits, plus expense reduction, plus revenue boost.
Sorry, how much reduction in expenses?
It depends, like there's a lot of other variables, but for the sake of this, like, okay, so their issuance expense, which is about 80, okay, their total issuance, they have two expenses, right? You have to pay the employees of the company. That's one expense.
No, just on the curve pools.
Okay. So that I think should be 100%. I don't think you should have any, you should have to have any incentive for that. Because there's just going to be an arbitrage around volume.
I guess I'm just like, I think
70% or so of their issuance goes to those pools, if that's what you're asking. And that 70% will basically be reduced to zero.
I remember Ham's like tweeted about this impact. He says like most discuss Lido upside in terms of STETH adoption post merge, but once Shanghai upgrade occurs, Lido's token will be able to turn off ETH pool emissions incurred.
Yeah, that's what I'm saying.
Right, but he's saying this removes dump sell pressure of 6% of circulating supply annualized. Does that sound?
Yeah. So what he's talking. So no, there's two separate things. He's saying they issue 6% of all tokens outstanding. I'm talking about a different percentage, which is of the tokens that they emit, what portion of them come from these emissions? There's two separate numbers. He's saying like they issue this. He's taking the amount that they reduce versus the total amount of tokens outstanding. I'm just saying the amount of reduction versus the total amount of annual issuance. This is just two fundamentally separate.
So your one is a little bit more of a sensitive number, like flows wise, right?
Yeah, I'm just saying like of all the tokens they issue, they're going to be able to stop issuing like 70% of them.
Okay.
So if you want to go, yeah, go ahead and go.
Well, I was just like a small thing. It's just like, so you made the really good case for the fundamentals of liquid staking derivatives and how you can build, we have this whole fundamentals and their flows thesis for Ethereum. You can take all of that and package it into a fundamentals case for these staking derivatives. But I think just also keep in mind, knowing crypto markets and how crazy they can get also, these assets are very small. And so the other thing just to think about in the back of your head is we're not talking about a $200 billion market cap staking derivative protocol. You're potentially buying a Rocket Pool protocol. I mean, what's the market cap of Rocket Pool right now?
It's about 400 million.
400 million, yeah. So this thing can move much more. And so, I mean, I think the fundamental case is strong, and all of these like speculative manias come from a strong fundamental backdrop. But just something to keep in mind is that like part of this is also then going to just become like if we get this big post-merge move, the assets that are involved in the move are going to get the most flows, and the smallest, most illiquid assets that are not even listed on Coinbase are going to be the ones that get the most volatile swing.
So yeah, I'd say a few things, and then I'll try to wrap up all I have to say. I would agree with you. Like if we're just talking about this from a technical standpoint, like I think there is a potential around the merge to see like a crypto mania, crypto frenzy, where you have like mainstream media like shouting from the rooftops and just blaring this thesis of like biggest protocol upgrade in the history of crypto, first real structural demand asset, triple halvening, first real yield, and you get like all this mainstream media publicity.
Don't forget, like, those are all really good. Those are all really good reasons, but from a media perspective, the one that they're
I just think it's a very
the one that they're likely to harp on, we haven't even touched, is the energy reduction thing.
Yes, okay. So energy reduction, they're obsessed. All those things.
Yes, the ESG angle is very huge with the mainstream.
Yes, the ESG angle.
We didn't touch on that because it's just understood, implied. But I think that will be like a very good positive mainstream amplifier for this as well.
Right. And so I think there is an opportunity. All these narratives are extremely digestible, extremely MSM friendly. There is a possibility that you get like a frenzy and a mania around the merge. And I think that probably starts like around now as the date's been set, and there's just going to be like endless publicity over the next month and obviously following. And if that is to occur, then I think it is logical to make the assumption, as Nikhil has done, that the least liquid things will appreciate the most and the fastest, as it's just at that point it's not about fundamentals, it's just a liquidity question. It's just, okay, there's XYZ amount of buying, how much does it move price? Because those buyers are price agnostic. They don't care. So that I think is correct. If you're looking for something that's going to be like a chance of like crazy upside volatility, like this is the right place to look probably. And then I just say like a couple quick things. I think there's a lot of concern about Lido in that, yes, maybe they generate revenue, but they don't actually return the revenue to holders. I think this is a really common concern. And the thing I'd say about this quickly is just that, yes, it's true. They don't return any revenue to holders. However, I would be quite concerned if they did. It's a startup business that burns cash. And they actually just talked about doing a raise like a week ago or 2 weeks ago to cover their cash burn. So how is a protocol that's needing to issue tokens to cover costs going to turn around and return the small amount of profit that they do generate back to holders to issue more on the other side from some other agents? It makes no sense. There's like that'd be the equivalent of like a startup business that just raised and is 2 years old. They're like, okay, we're going to start giving back the small amount of profit that we do generate to investors, so that we have to raise more money on the other side to fund ongoing operations. Like it's nonsensical. And so I don't think that they should. Now, that doesn't mean that they won't in the future. I actually do think eventually they will. Like when they reach a point of greater maturity and that it makes rational sense to address that cash return policy, I think they will. And then, so the common comparison people will say is like, okay, yeah, so what? But Uni generates a ton of revenue too, and they just don't return anything, so the token's useless. The comparison of Uni to Lido is completely misguided. Uni has a separate issue. Uni, the issue is not that they generate revenue and don't return it, is that they don't generate any revenue. The revenue with Uni is the rewards that liquidity providers generate for using the protocol. But that is not revenue that accrues to the Uni protocol or the DAO. That's
zero gross
margins. LP providers. Zero. So their concern is not that they don't generate any, it's not that they don't return the revenue they generate, they don't generate any revenue. And the reason they don't generate any revenue is because they don't want to increase fees, because they don't want to hurt their market share. So that's an entirely different discussion. With Lido, they're in a dominant position. They generate a ton of revenue. They just don't return it yet because they shouldn't. And
Uni is
so go ahead.
Yeah, Uni is not a good example because of that mechanic. But what about to other DeFi protocols like Maker and other things that do generate?
Yeah, so
fees?
I think it fits into that. I think it fits into that group. And then I think they all, at the right time, when they return on their capital for them to spend it internally is lower than the return on capital if returned to holders, then they should make that switch. But until that point, they shouldn't. They should prioritize growth. And when it's appropriate, they will, I believe.
And pre-merge, there's no way that'll be.
Yes, this is a long-term discussion. It's just like a common concern. And that's just my views on it. And then the last thing I'd say is that Lido is not the only liquid staking provider. I don't want to come across as like that, I only support Lido and like Lido is just this like best provider. Like I don't think so. And I do actually have concerns about their market share. They're at 30. And I think if they get towards or above 33, you start to have actual concerns, even though I think they're somewhat overstated. I think you do start to have concerns about credible neutrality. So I would advocate for Lido remaining sub 33%. I don't think that meaningfully impacts the investment case because I don't think they need to rely on market share gains to generate their growth. We just articulated how they're going to grow 440% with no market share gains. But that dynamic does provide an opportunity for the smaller players where if Lido does lose 2 or 3% of their share and a 1% provider goes to 3% or a 2% provider goes to 4%, then they all of a sudden double their market share. So these smaller players are actually even more potentially sensitive to these things happening. And so the two that I think are probably most investable are Rocket Pool and StakeWise. And I think they both have sort of unique applications and unique parts of the thesis that I'll just touch on quickly. And just full disclosure, we at North Rock own all three of these, and we have owned all three of them for a while. Rocket Pool, I think, is unique for a couple of reasons. One, their actual staking mechanism has quite unique tokenomics where you need RPL to pair with your ETH to stake your ETH and generate outsized returns on your ETH. And so it creates this knowable and guaranteed demand for RPL as staking participation increases. And that is obviously at Flow's advantage post-merge, when we think staking participation rate is going to go up 250%, because all that new ETH that needs to be paired with RPL needs to purchase RPL to pair with it. And then the second thing is that because they allow that pooling, they allow you to pool your ETH with other participants' ETH. The actual minimum amount of ETH required from a validator perspective is lower. It's only 16 ETH for 32 ETH, and there's a lot of discussion in the DAO to further reduce that towards like 3 or 4 ETH. And that is also advantageous because it further, well, first of all, it incentivizes even more outsized returns, which increases the value proposition of the protocol, but it also further increases the decentralization, which is another reason why people use it, which makes it a kind of perfect complement to Lido and a potential market share winner of any share loss they lose. And then StakeWise is more of just like a direct competitor with Lido. They function in much the same way, but I think there's a couple unique things about them. One is they have talked about actually turning on that fee return. Like they're probably further along in that discussion than anyone else, and they definitely plan to do it. So with them, it's not a question of like, are they going to turn it on? It's just when are they going to turn it on? It's like they've said they're going to. And also, they are very institutionally focused, and they've set up a lot of different variations of their core product to cater towards institutions, which should position them particularly well for a post-merge world where institutional adoption may be growing. So those are the three that I think are most interesting. Preference between the three, I think, is impossible. I think the market is pretty efficiently valuing them, and personally, we just own all three.
Nikhil, any other thoughts?
No, I think that covers it pretty well. A lot to look forward to.
Well, that was a quick 2.5 hours. We got a lot in
very
there.
epic. I guess you know, with crypto, one of the tricky things about like taking information and setting up trades is just a matter of time frames. I think we've presented roughly. I mean, my read is there's like 2 theses, like in terms of time frame. There is the merge thesis, which is that like there's a huge tech upgrade that will change flows, that will change narratives. Narratives can drive price, and price will drive narrative. And like, I guess over the next rest of 2022, that's a intermediate-ish short-term positive view on Ethereum. And on a more multi-year time horizon, how I think you've argued that because it has ETH, with the success of this upgrade, if it happens, will have superior cost efficiency and security than this Bitcoin. And that could, over a long arc of time, change people's minds about how they process it. There are other things that I guess that is positive, that's not even in your in the way your motto is arguing for the price appreciation. For example, obviously post-merge ETH will become a real yield asset with this 5-6% kind of yield, distributing the yield from the participants of this like world-class casino, is positive sum casino, as its first use case. And that has the ability, once fully digested, to draw on institutional capital that in a way that is never before. So like that is that baked into your motto, or is that kind of like additional narrative upside?
Well, first of all, I just say I think you really synthesized that well. So I think you did a good job there. But second of all, I don't really have a model for price. So like, I actually don't have a price target. Like, I don't know where the heck Ethereum is going. Like, I couldn't tell you. It's a function of liquidity. I don't know. It depends a lot on macro. It depends a lot on a lot of things.
And how do you determine your exit points, or how do you even think about exit? Let's say some of this stuff happens.
I mean, so I think about all these things, entry, exits, etc. Way, way, way less about price and more about time. It's like when certain things have happened and things appear a certain way, then you will do X, Y, or Z. But it's not a predetermined, okay, if Ethereum hits $3,000, I sell everything. Like, I may sell before then if certain things have happened, or I may not sell above then if certain things have happened. Like, it depends. Like, it depends on, and I think that's a really important thing as an investor, is just like keeping an open mind and checking your bias at the door. And like, when new information flows in, you synthesize it and change your views. And so, like for me, there's no reason that these price levels mean anything. Like they're just functions of liquidity. Like I don't know what price it's going to be. But for me, a much more thing is about time and just like the environment. Like when it's the right time to buy or sell, if you're really paying attention and you know what you're doing, you'll know it regardless of price.
But surely the price, just incomparables, have some relevance. Like Ethereum today is 200 billion. If Ethereum's become a trillion, it's like an Amazon-sized thing.
It's really hard, honestly.
Thing. You know, it's like
yeah. I mean, around edge cases, like yes, like okay. So if the Ethereum network was worth like $1 billion, yeah, I'd buy every last ETH token I could. And if the Ethereum network was worth $5 trillion, yeah, I'd sell. Well, okay, maybe someday it'll get there. But if it was there now in the current state, yeah, I'd sell every last ETH token I could sell. But like in the in-betweens, it's very kind of like, okay, at 2,000 or 3,000 or 4,000 or 1,000, it's like, I don't know, should it be 100 billion or 200 billion or 300 billion or 400 billion? Like it's hard in those things because, and actually, if you want to know the truth, the fundamental reason that it is hard like that, like, because I wouldn't say the same about equities. Equities are different. But the difference is that, and this is kind of a key point, the earnings is very reflexive with price. So you don't have like an earnings base the same way you do with an equity. Like the S&P, you know, the earnings might fluctuate a little bit, but if the S&P goes down 50% and it's trading at a 9 times multiple, like you can be pretty assured that that's a good buy because the actual E doesn't change. But the problem with crypto is that when it sells off, the E sells off with it. So the valuation doesn't actually get cheaper. And likewise, it's actually a boost on the upside. When it goes up, the earnings doesn't stay low, it rises with it. And oftentimes it rises more. So it's not obviously a sell there either. Because of that reason, because of the earnings reflexivity, it's much, much, much harder to talk about fundamental levels with any certainty.
Well, yeah,
at least in this in between,
maintained,
before the extremes.
Yeah, that's why I've always maintained, like, the longer we go, the potential for like really extremes behavior that, like, especially post merge, gets wilder because we get these. It's like you have an environment that's cyclical in both the upside and downside already. So the higher price goes, the higher it can go. It can also fall quite a bit too. But the point is, like, the reason where that comes from is because fees are rising with it. And the tighter that fees bound to price, in theory, that should amplify that effect. And so, again, it doesn't mean, oh, like, we're going to go straight up, but it does mean that in the event that you start to see Ethereum moving up a lot, if you say, oh, like, Ethereum hit 10,000, that's my sell number. I mean, that's where I would say, be careful, because the potential for variance, if we're at 10,000, the potential to go to ridiculous numbers, it becomes very high because the fees are going to, like, your potential yield at ETH 10,000 is probably going to be higher than it is now, not lower, because the fees are going to go up by so much. And so people are going to be making the case at ETH 10,000 that, well, you know, ETH is 10,000, but the yield is 15%. So why can't it go to 50,000? I mean, that's how narratives build, right? And so, I don't know. I mean, that's where I got to my, like, really, really high price targets that obviously have not panned out at all. But I think it came down to that thing. It's like, if we're making a flows and like market microstructure trade, there is going to be much more variance than you're expecting to see. And if crypto's already been a very high volatility asset, and we're saying it's going to be more volatility than we've seen before, you can't make a decision based on a fixed price target, or you will regret it. You need to make a decision based on whether you think those flows are turning.
Okay, well, I was going to ask you guys for like price predictions, but I guess you just answered no price predictions because it's complicated.
Yeah, I've never made one, and I won't.
Well, in my like original report a year ago, I made tons of price predictions. They were all based on like pricing models that one, I made a pricing model based on, you know, taking Bitcoin valuation models and comparing them to Ethereum. A lot of those valuation models have already empirically been broken. Like if you look at stock to flow models and things like that, they're just already been falsified. So you can't map that over. I think I did some things based on earnings. So you look at like PayPal earnings compared to Ethereum. But again, like once you look at the cyclicality of Ethereum's earnings, you just can't apply them. So I don't. Yeah. It's become like really difficult to attack a price target, which for me was just like learning, and that's tough. But I mean, Hal's probably smart to not make price targets in the first place.
No, crypto is a function of liquidity, not fundamentals.
Okay.
in a lot of ways. Fundamentals matter, but
This has been a great chat. I guess maybe we should leave off just with some thoughts and I guess perspective or advice for listeners as heading into the merge. I think each of us are positioned long ETH in some flavor or another in conjunction with LSDs heading to the merge. What advice or thoughts or drops of wisdom or alpha can you share for people to think about as they head into this? Obviously not financial advice from any of us.
yeah, I mean, like I wasn't even going to really give financial advice. Like, yes, obviously I'm long ETH and all the things we talked about, but that's not the advice I'd give. I would just say, like, first of all, it's just like a really exciting time. I mean, I think the whole Ethereum community has been waiting for this for many years. So it's like pretty exciting that we're within a month. It's like, 4 weeks away. I just think that's exciting. But my advice would just be think for yourself. Like this is something that I try to do a lot of. Like I try not to get most of my inspiration from like other people's views. And that doesn't mean that I don't regard it. And like all the things that we've said today, you should think about them, and like if you think they're relevant, research them yourselves and go through the first principles yourselves and come up with why these things are as they are, and really think for yourself and try to come up with your own views. And these, the things that other people say can help guide that process. But I think ultimately, if you want to really have conviction and you really want to be able to stay strong in your positions, you kind of need to understand them for yourself. So that would be my advice, would be think for yourself. And I think like that's something that's underappreciated. Like in crypto especially, there's so much volatility that if you don't have that conviction, like you will get shaken out. You will sell the bottom, you will buy the top, that's why it trades that way, is because it's so prone to that. So like it's so important in that context to form your own views, use other people's information to help form those views, but ultimately you're the one that needs to form the views on your own. And that would be my advice.
Great, thank you. Nikhil, any thoughts?
Yeah, I would think it's a similar idea, but I think it's when you're looking, like the merge is a pivotal event. And so I think people are so used to at this point just being like, will the merge happen is the discussion. Will the merge happen? And I would say, take Hal's advice and apply it to assume the merge happens. What are people going to be talking about on the day of the merge, a month later, 3 months later, a year later? I think if you asked all of us, we'd probably have a bunch of different narratives that we think are more or less likely to play out and how they might affect different assets. And you don't want to be reacting to these narratives that can be fairly predictable if you look out into the future. I think a lot of people, because they're so used to this idea that you plan for what's going to happen after the merge and the merge never comes, have kind of stopped thinking about what would the world look like if people baked the merge into their expectations because it's already happened. And I think we all agree that a lot of the potential alpha in this space is about thinking about, well, if the merge does happen, because we have had a date set, how does that change this space? So kind of echoes what we've spent the whole podcast doing, but I think there's a lot that we haven't talked about that if you just come with an independent mind and go, okay, the merge has happened. What is the dev team focusing on? What is Twitter going to be talking about rather than what has already been talking about? And where will that lead the money to flow? There's a lot of opportunity there.
Yeah, that's great. That's great thoughts.
What do you think, James?
I guess on my end, one kind of like as a modifier to what you said is that, think for yourself. I curate a lot of Twitter lists and I listen. I do not these days have the inclination to do too much, like to do first principles work, which has been recommended. I think it is very good for those who can do it, but also I think it's important to recognize that it's not everyone's appetite or temperament to do first like principles analysis of very, very like technical stuff, like a blockchain with all these parameters. And so if you're not inclined or you don't have the time to do that, what do? I think one thing is important is that even obviously you're going to consume a lot of other people's digests and read reports you guys have put out are very helpful, but knowing how to take advice is also extremely important. Like if you're not going to be the first generator of original research, you need to consume it and take it like it's buy side, sell side. But how you consume advice and how you act act on it is extremely important. I think most people are in this scenario in some way or another. Some of the mistakes I made in the last year was just not knowing how to weigh different people's takes on different time frames. For example, there are a lot of great smart traders on Twitter, and they will tweet out all kinds of stuff, and it can be very noisy. But often they're tweeting stuff on different time frames than what you may be doing. They may be trading the next like breakout ascending triangle, and you're like trying to determine if you hold something for a year or three, and those can confuse you. And I've certainly had my share of being shaken out of positions because I haven't really thought about it correctly. One caution I would give people about just taking tips from other people is that it's very easy for someone to give you a tip to buy or sell or whatever a position, but it's very rare that they are around to equally give you the counterpiece of advice. For example, someone say on Twitter, buy XYZ token or stock, you might read that and buy it because you agree with them. But they may never tweet out, I'm selling for blah, 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 or they may tweet it out and that tweet never reaches you. So you only get half the advice and then you totally round trip or even lose money on it. So if you're going to take advice, you need to have a way of system of like making sure it's going to holistically work for you and not just follow only the buy signals and then one day look around, it's like, oh, what happened to that thing? Oh, he doesn't even believe in that anymore. I'm here holding the bags. That's a position like I think normal people can easily be in. So just be thoughtful around that. And the other thing I might say is that like short of, you can easily spend a lot of time and mental energy and it can be very like draining. Another way to deal with this is just to make it easier for you. And the way to be easier is just to have less demand for short-term high rewards and just to elongate your time frames. Like I think based on everything you've said, we've discussed here, ETH is pretty bullish long-term. If you hold it for multiple years, chances are your expected value and outcome is positive. If you can be at peace with that mindset and not try to catch the intermediate moves, you will probably make money, right? It's not guaranteed, but chances are you will make money. It's a pretty safe bet. But if you try to be like very clever and try to squeeze alpha out of every quarter, it becomes a much more difficult game. And so that's a difficulty you impose on yourself and you don't have to. Maybe your real job is, selling lemonade. You do not have to impose that difficulty on yourself. You can always make the game easier for yourself. And that's an option you can always take.
I think that's fair. James, thanks for moderating.
Yeah.
Okay.
So much.
This has been a great chat, guys. It'll be exciting. Maybe we'll do this again sometime, but it will be very interesting to visit this in a few months and a few years. It's been a pleasure.
It was a pleasure. Thank you, guys.
Hal, Nikhil, thank you. Bye-bye.